I think there will continue to be a debate. We don't know how high it will actually go from here. And I think that's an uncertainty going into 2024.
Well, Ben, thanks so much for joining us. Ben Emmons, head of fixed income at New Edge Wealth, joining us on a slower trading day a little bit here when it comes to heading into the Labor
declining
Day
yields that we were talking about earlier.
Right.
That's just like, where did that go? 2-year is 485. I'm going to call that pretty much unchanged.
Right. And then also moving over, looking at the stock market here, S&P 500 still trading above 4,500. You do have energy stocks, though, up over 1.5% here. So seeing a big move there. Also oil prices. We'll have more coming up. But first, let's get more with world and national news from Amy Morris.
All right, thank you, Jess. President Biden is now asking Congress for $16 billion in disaster relief after the wildfires in Hawaii and the hurricane in Florida. That's up from an earlier request of $12 billion, and it's on top of another $28 billion that the president wants to assist Ukraine and boost border security. We get more on that from Bloomberg's Jody Schneider in Washington.
The White House has already proposed $40 billion in a supplemental request, including $12 billion to replenish federal disaster funds from things like this hurricane and the Hawaii wildfires, but also more than $20 billion for humanitarian and weapons assistance for Ukraine. And that part is going to get a lot of scrutiny from Republican lawmakers.
Bloomberg's Jody Schneider in Washington. President Biden also traveling to Florida. This is tomorrow to survey the damage from Hurricane Idalia. Homeland Security Advisor Elizabeth Sherwood Randall says the president is prioritizing those recovery efforts.
He has directed us to ensure that we have a fully coordinated whole-of-government effort to support people in the aftermath of this storm.
Some 1,500 federal responders are already on the ground in Florida. Record numbers of migrant families crossed the U.S.-Mexico border in August. Data obtained by the Washington Post show the Border Patrol arrested at least 91,000 migrants who were crossing as part of families last month, exceeding the record set in May of 2019 of more than 84,000. Border apprehensions have risen more than 30% for 2 consecutive months. Meanwhile, Massachusetts Governor Maura Healey is activating the National Guard to help provide basic services at some of the hotels being used as emergency shelters for migrants. Healey declared a state of emergency over the migrant crisis earlier this summer. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash being brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM insured bonds. As we look at the BAM, where's Matt when you need him? S&P 500 right now, 16 points higher, up 0.4%. We're at 45.23 on the index. The Dow Jones Industrial Average up 168 points. That's up about 0.5%. And the Nasdaq 100, 11 points higher. That's up about 0.1%. Pairing some of the earlier gains and partially in the driver's seat, the yields. The 2-year, remember, that was down as much as 10, 11 basis points after the jobs report this morning. Right now, it is at 486, so I'm going to call that unchanged. In the equity markets, right now leading the way in the S&P 500. In the broader market, the best performing industry group, that belongs to energy as oil prices rise. NYMEX crude oil up $1.52 a barrel, 85.15. That's not a good indication as I jump in the car for this Labor Day weekend. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Jess.
Here in the Bloomberg Interactive Brokers studio with myself and, of course, John Tucker, continuing this morning. That BAM, though, I liked it. Not I feel like it's
That's
not quite as much
here.
enthusiasm as, of course, Matt Miller, who I believe is in Europe right now on a well-deserved vacation, as well as Paul Sweeney, who has the day off, who I'm assuming is probably at the U.S. Open.
You think so?
I'm just guessing. I'm just wagering. I know how big of a tennis fan he is.
Where the elite meet in Flushing Meadows?
So we'll continue on this morning. We'll try not to break.
Where they charge like $25 for a hot dog?
If he's not there today, I'm sure he'll probably be there this weekend. But I want to get straight to our next guest. I mean, John, you know, we've been talking about the jobs report all morning, but I want to bring in Julia Pollack, who's joining us on Zoom. She's the chief U.S. economist at ZipRecruiter, who's going to break down some of these job numbers. So we've gotten the sort of the surface level take here from the macro side of things, but I wanted to get more of your thoughts when you're looking from an industry level in the job market. What particular corners are holding up better than others at this point?
Sure. So we've seen the job mix sort of shift back to normal, with healthcare and professional business services leading the way. This is an interesting report because it really shows you very clearly what's happening in certain industries. We saw truck transportation lose more than 36,000 jobs. That's largely results of yellow freight that business's closure. We also see signs of the Hollywood strike in this report, with more than 16,000 jobs lost in the movie industry. So, you really get a very granular look in this report at how differently things are playing out in different industries.
Okay, so what does this mean for the path ahead for the Federal Reserve as far as interest rates?
So, I would liken this report to an aircraft sort of cruising at the perfect cruising altitude. If a plane goes too high, you go.
When you say Goldilocks, that's our drinking game. So every time a guest says
we've been keeping
that,
a tally,
we take
Julia.
a shot this morning. But that's a new metaphor. I like that one too.
Trying to use a new one, exactly. I was worried that perhaps the long and variable lag of monetary policy would start to squeeze too much air out of the room and choke growth. And it doesn't appear that that's happening yet. This labor market appears to be running at a sustainable, solid pace that is not going to fuel inflation, but that is going to continue creating opportunity for workers.
We did see earlier this week, we also had, as you know, the JOLTS data that came out that did show that U.S. job openings did decline to the lowest levels since early 2021. What are you seeing when it comes to some of the quit rates?
Yeah, so this report suggests that Fed Chair Waller was right, that high interest rates would slow the labor market, but that because there was so much excess demand, that slowing would come in the form of falling job openings, not of falling employment. And that's still what we're seeing. The labor market does appear to have come pretty much all the way back to normal. When you look at just sort of the labor market dynamics, the quits rate is all the way back to normal. Online job postings on ZipRecruiter are all the way back to normal. JOLTS openings are still high, but they lag a little bit, and they may also be a little inflated for a number of reasons.
Do you see evidence there of, what do we call it, labor hoarding, where
Right.
especially small businesses that had such a difficult time, at least according to the NFIB statistics, finding qualified workers, they're just hanging on to the people that they have right now?
You know, there are a few industries, very unique, peculiar industries, where employers are hoarding labor that is relatively idle. The examples I could give are things like consulting companies, your Bains and McKinseys, with the tech industry entering this year of efficiency. Tech companies are not paying for management consultants to come in and run all kinds of projects for them. And as a result, you have all these Ivy League educated consultants sitting there watching Netflix with very, very few projects to work on. That's a rare case. In normal industries across America, when workers are idle, they get furloughed or laid off. That's not happening in some of these organizations because they worry about the long-term impacts. You know, you don't want to lay off a bunch of Harvard graduates who are going to be future titans of the universe and then shoot yourself in the foot come the next recruiting season. But that's a very unique situation. In most of the country, I would say the country is still understaffed. Go to a restaurant, go to an airport, you'll see lots of check-in counters and very few check-in associates. And so long waits, low customer satisfaction, those are still big problems in the economy. And for the most part, employment levels are below what would be predicted by spending levels and activity levels.
What are you seeing when it comes to temporary employment?
Very interesting. So we've seen a very large drop over the past couple of months since early 2022 in the number of temporary help services employees. Over 200,000 of those jobs have been lost. And that typically is a signal of a recession. It's caused many of the sort of leading economic indexes to suggest that we're in for a big downturn.
So how much of a potential lag would that signal as far as looking ahead to that? Like how far ahead would that signal a potential recession?
Usually it's only about 3 to 4 months ahead, but we've been seeing this indicator decline now for a year and a half. And I would argue that this time is different. The decline is a return to normal. It is a good
because
thing.
Of the pandemic.
Yes. So during the pandemic, companies were so short-staffed that they were forced to rely excessively on overtime hours and external agency staff. Now, as they build up their own internal staff, they no longer need to rely so heavily on external agencies.
Using the ZipRecruiter data, can I tell my college graduates what industries to look in? Where the biggest, what do you get when you're a philosophy major? Ooh. What are they paying philosophers these days?
Right, so there are big differences across college majors. We have a college grad report that discusses these in some detail on our website. It is those STEM fields that are still getting graduates the biggest paychecks, computer science, and all the healthcare fields. Healthcare is showing unstoppable demand for workers. There are huge staffing shortages in many different occupations there. Physicians are retiring in huge numbers. We expect by the end of this decade that 40% will be over the age of 65. And that's creating huge opportunity all the way down. So nurses are moving up into becoming physician assistants and nurse practitioners. Hospitals are having to pull out all the stops to retain nurses. They're increasingly offering training programs for CNAs and less educated workers to enter those kinds of roles.
Julia, we only have about 20 seconds left. What's the top concern that employers have when you speak to them?
They are still worried that there could be a downturn ahead. They're worried that the U.S. consumer will be hit by these high interest rates on credit cards and auto loans, and they worry about the student loan debt resumption just around the corner.
All All right, Julia Pollack, Chief U.S. Economist at ZipRecruiter, joining us to break down the latest jobs numbers that we did get this morning, JT. Looking at the stock market, S&P 500 energy sector up about 1.5%. You have U.S. futures when you're looking at oil prices trading around $85 a barrel. We'll have more coming up. This is Bloomberg. Now let's get some company news with Bloomberg's Lisa Mateo.
Thank you, Jess. Major financial institutions are getting serious about workers coming back to the office. Bloomberg's Steve Podisk has that report.
Once Labor Day is behind us, most banks will require employees to be in the office 3 days a week. But some want more. Investment firm BlackRock will tighten its requirements from 3 days to 4. Goldman Sachs expects employees to be in the office 5 days a week. According to office building security firm Castle Systems, less than half of all office workers are back at their desks.
Now, shares of BlackRock right now up about 0.6%. Shares of Goldman Sachs up about 0.3%. The pharmaceutical industry's legal fight against Medicare's drug price negotiation program is likely to gain steam. Bloomberg's Jeff Bellinger has details.
Drug makers selected for the first round of lower government negotiated prices have just a month to sign those agreements, but some of those manufacturers, including Merck, Bristol-Myers Squibb, and Johnson & Johnson, are taking the fight to court. The Pharmaceutical Research and Manufacturers of America is asking a judge for an early ruling in its own lawsuit. The Chamber of Commerce and some state and local affiliates requested a federal judge pause the program. That decision could come this month.
Now, shares of Merck right now, they're up about 0.8%. Same for Bristol-Myers right now. Johnson & Johnson shares, they are down just a fraction. And the CEO of Walgreens is stepping down. The company said it was a mutual agreement between the board and Rosalind Brewer. Now, Ginger Graham, who's the current lead and independent director, is taking over as interim until a replacement is found. Shares of Walgreens right now down about 3%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Jess Mitten and John Tucker here at the Bloomberg Interactive Broker Studio, doing a quick check on the markets here, looking at energy stocks up about 1.5% with U.S. oil prices trading right around $84 a barrel. You look at the S&P 500 up about 0.2%, the NASDAQ 100 virtually unchanged. But before we get to more, we have Amy Morris for World and National News.
All right, thank you, Jess. More than 3 weeks after a wildfire devastated Maui's historic town of Lahaina, Hawaii's Governor Josh Green says they've opened several investigations into people who have allegedly tried to buy property there in violation of that new emergency order. The governor adding now they've enhanced penalties for those who are found guilty of violating that order.
We want to keep this land in the hands of local people, and we want to give them at least a chance to decide whether they'd like to build back.
Now, meanwhile, the number of people missing is expected to fall into the double digits. Officials are preparing for an update later today. President Biden now requesting an additional $4 billion in disaster relief from Congress in the aftermath of Hurricane Idalia and the recent fires in Maui. The ask substantially increases the cost of a sweeping emergency package requested by the White House just weeks ago. The Office of Management and Budget says the administration is now asking for a total of $16 billion, quote, given the intensity of the disaster activity around the nation. The proposal faces a difficult path on Capitol Hill. If lawmakers in Washington don't pass spending bills or a continuing resolution, a government shutdown could be coming in about a month. White House Press Secretary Karine Jean-Pierre.
This is something that Congress can do. They can prevent a government shutdown. They need to prevent a government shutdown.
Congress has until the end of September to pass a short-term funding measure to keep that government open. Donald Trump's election interference trial will be broadcast live on YouTube. The judge presiding over the indictment of the former president has ruled that all of the Georgia court proceedings will be live streamed on the court's YouTube channel. Trump and 18 other defendants face state racketeering and other charges related to alleged efforts to overturn the 2020 presidential election results in Georgia. Trump has pleaded not guilty. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg, John and Jess.
Thank you, Amy. We appreciate it. Coming up the next hour, we're going to hear from President Biden, so stick with us for comments from the president on Jobs Day. Bloomberg Markets is now on YouTube. Watch us every weekday starting at 10 a.m. on your TV, computer, or smartphone. Just visit youtube.com and search Bloomberg Global News. JT.
Does sentiment matter when it comes to Wall Street, and how do you measure that? And what does it indicate? And what kind of a track record does it have?
What a great question. I wonder why.
This is the opportunity, by the way, everybody, for Jess to talk her own book.
So my other job that I have, my day job, I do write stories for Bloomberg News. So this morning I was writing up, Bank of America has their sell side indicator that they put out each month. It's from Savita Subramanian, who is obviously their equity strategist at the firm. So when you're looking at this sentiment for U.S. stocks, it actually was a little changed in August, but it did have quite a bit of a rise over the past 2 months, as we know some of these Wall Street firms turning a little bit more bullish. But the point of watching some of this when it comes to the sell side indicator is it's typically viewed as more contrarian. So if you're on one spectrum or the other, say if you're typically more bearish, that for Savita, she tends to get more optimistic on where stocks could be headed, but it's kind of been around the same range the past few months. But nonetheless, really what matters and the takeaway here is when it's at this current level where it is right now, she sees at least a 15% price return over the next 12 months, which translating that, it would be the S&P 500 trading around 4,700 by year end or roughly 5,200 a year from now. So that's their latest update here when you are looking at that. And historically, the indicator has been, when it's been trading around current levels or lower, that forward 12-month return for the S&P 500 was positive around 95% of the time. So that's Savita Subramanian and her team over at Bank of America with their sell side indicator.
And you
JT.
can certainly read more on the Bloomberg from Jessica Benton.
Hey, you know.
Both stock indicators. The S&P 500 rising. So I think you can also get it on the web or, you know.
Yeah, you can read it online, also on the Bloomberg terminal. Go to my bio page and also read more from our U.S. equities teams. So we'll have more Bloomberg Markets coming up. Starts right now.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Jessman and John Tucker here in the Bloomberg Interactive Brokers studio for our second hour here for Bloomberg Markets. Of course, Matt Miller, Paul Sweeney do have the day off, so stick with us over the next hour. We do have coming up, President Biden is expected to speak shortly on the latest jobs report around 11:15 Eastern, so stay tuned for that. Also coming up, we'll have Tim Fury from the ISM Business Survey to walk us through that latest print, Joe Misick from Bloomberg to weigh in on the muni bond market, and Jan Ellis from the Jobs for America's Graduates on the latest jobs prospects for students heading into the school year. But first, let's get a quick check on the markets with John Tucker.
On this data-heavy day, right now, we have the markets turning mixed. The equity markets, at least, done a round trip as far as yields. The two-year right now unchanged at 486. In the S&P 500, you have 7 of the 11 major industry groups. They are in the green right now. That is being led higher by energy shares right now as we see crude oil prices rise. NYMEX crude, $85.04 a barrel. That's up $1.41. And, of course, you had the data today, cooling U.S. job market, giving the Federal Reserve maybe some room to pause interest rate increases this month, while also keeping the options open for another rate hike later in the year. We also had a little later a measure of factory activity. That shrank less in August than the month earlier. Kind of a hopeful sign there that the malaise in manufacturing no longer deepening. Right now, the S&P 500, 6 points higher. That's up 0.2%. Of course, pairing the earlier gains that we saw on the index. Right now at 45.14. Dow Jones Industrial Average, that is up 117 points. That is a rise of 0.4%. We're at 34,842 on the Dow. And the tech-heavy NASDAQ 100 right now, 28 points lower. That is down 0.2%. Some of the best performing stocks in the index, the individual stocks, shares of Apple right now, they're up 0.4%. That accounts for about 15 of the index points in the S&P 500. And I mentioned oil, Exxon Mobil, one of the individual shares on the move right now. That's up 1.4%. And some of the laggards in the broader indexes right now, Tesla, that is down 3.9%. And NVIDIA Corporation, that is down right now about 2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess Menton.
Here I am, still here.
She does it all.
Always a pleasure doing this with John Tucker. And what time do you come in? 3 in the morning?
Actually, I hate to admit it, but my alarm clock went off late this morning, so I got up. I rolled out of bed at 2:50 a.m. That's really late for me.
Whew.
So no, I usually roll in just before like 3:50. I want to say every morning here at Bloomberg LP.
When did you decide that you wanted to be the voice of radio? Because you have the perfect voice for it.
Well, you're so sweet. You're so sweet. When did I decide? I think it was decided for me in college. When I was did the college radio, WFDU in Teaneck, New Jersey, 89.1, the voice of Fairleigh Dickinson University, where in addition to being a news person, I was also the jazz DJ in the afternoon. You know what I know about jazz, Jess?
What?
Not a damn thing. But that didn't stop me.
Well, there you go. I love that. What a great story. John Tucker. I want to switch gears here. Focus on Munis is brought to you by Build America Mutual. BAM! Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM insured bonds.
And the last time our municipal bond guru, Joe Misick, was here, I did give him an assignment to find out why the big Ferris wheel at the American Dream Mall in New Jersey. What is that, Rutherford? Why it's not working? Or at least I've never seen it going. And we know that in the annals of municipal bond news, that's a real standout.
It is. Right.
The voice of Joe.
Not for good reasons.
No.
Joe Misek right here with us in studio.
Yeah.
Thank you.
The American dream.
So, municipals continue to outperform U.S. Treasuries this year.
I didn't get my answer to the why.
We decided we can go back to.
I'm still working on that one.
Okay, all right. Investigative reporting.
Yes.
So I'm curious because municipals do continue to outperform U.S. Treasuries this year, though some of that ground was actually lost last month. Why?
Oh, wow.
Really going in strong here.
This is, the munis have the yields have been rising, and supply is falling, and the Fed is, there's all this fear of the Fed, and the market keeps, talking itself, just fretting. So you're going to keep seeing this slide, I think. This is just not something that's going to go away. And I think Eric Kazatsky was quoted in our story this week saying, munis just aren't cheap enough. Right now, for example, munis yield about 70% of treasuries. They should be yielding about 90% of treasuries. So that's going to be weighing on munis for a while, I think.
But you get the
fall.
triple tax advantage when you do that. So doesn't that make up for it?
No, you get, hey, I'm not really one of these guys who follows performance, on a daily basis. I think it's bogus. But people like to look at it. I say, well, right now, okay, the 10-year muni AAA is at 285. And you could go out on the yield curve, you go out to 20 years or so, and you could be getting over 4%. You could be getting, almost fives sometimes, and that's 5% that you keep. If, Mr. Tucker, you buy in-state municipals, most states tax the tax-exempt interest, yes, on out-of-state bonds.
How do tax-free munis historically perform in September?
Bad. It is a weak month for munis.
And why is that? What's the dynamic there?
Couldn't tell you. Got me there. It is just historically, it's been an off month. And the real thing that is surprising is that supply is off. So you would think with supply being off as much as it is, that would be very constructive for munis. Supply being off, money coming in, and yet no, because right now we have so many. There's so many billions of dollars of municipal bonds that are dragging around like Marley's cash boxes, coupons of 2% or so. It's sort of the hangover of the last decade where you had almost record low rates, and so you have these 2 and 3% coupons out there, even ones, and these bonds are being beat up in the market because right now you can get new bonds in the 3s and 4s.
I thought everybody and his brother was doing some sort of infrastructure project, in the municipalities and whatever.
No, we have seen, for example, airports have come to market this year, but I would say volume's off generally. New issue sales, volume as we call it, are off about 11%, and that kind of goes across the board. As for the infrastructure, you have municipalities tend to borrow when they need. They're almost, they're not going to go out on purpose and borrow in a high interest rate environment. So that's had a slightly depressing adds a slightly depressing aspect to the market, if you will. So that's weighing on things. But they just tend to borrow when they need to. So yeah, you got that. But you also have all the federal government's money that is going toward infrastructure. So that, has replaced some new issue sales that we might have seen. So, Mr. Tucker, yes, people are out there borrowing for infrastructure, but they're being a little careful about it. And the federal government money, they're using that first.
Oh, because I'm just going to get one more in it. Are there municipal bond ETFs that are, people like?
Yeah,
very
they're
popular.
Yeah.
Is it drawing a lot of money?
There are some municipal bond ETFs. There's not a lot. People thought that this was going to be the savior of the market this year, or I should say, last year we had so many outflows from municipal bond mutual funds. Yeah, but it's still not a big developed market, if you will. There's still not loads of municipal bond ETFs. It's a very interesting market, but still kind of minor in munis.
All right, Joe Mizek of Bloomberg News.
No, that's it?
Unfortunately, Biden's coming up in the next few minutes, so we have another
no.
guest we're going to get to quickly. But bam, thanks for joining us in studio on a Friday. Always a pleasure.
You bet.
I want to get straight to Tim Furry, the chairman of the Institute of Supply Management. Looking at this latest data, looks like there's more stabilization when we were looking at manufacturing. Walk us quickly through what you found in this data and some of the bright spots here.
Right, I think you have it exactly right. So it feels like we're in the trough. We beat expectations in terms of the number. We actually grew higher than what the economic forecasts had predicted. This month is the number is above the 3-month rolling average, which is positive. We've been hanging around 47 and some change for quite some time now. So I think I can call it that we're in the trough. And one of the other reasons I think that August was a good month is that in the month of July, we had 93% of manufacturing output contracting, meaning that it was 49.9 or less. This month we had 63%. But more importantly, I really keep an eye on the industries that are contracting at 45 or less, because that's a real warning sign. And in the month of June, we had 44% contracting at 45 or less. In July, 25%. And now in the month of August, 16%. So overall, I think we had a pretty good month. Demand appears to be recovering. And the reason I'm saying that is that backlog is actually starting to come up above 40 again, which is good. We're starting to slow the decline in backlog, which is excellent. On the output side, production was stable month to month. Employment didn't contract as much as the month of July, but it's still contracting. And the majority of our panel, or a good significant amount of our panelists, indicated that they're trying to use attrition to get down to the appropriate employment levels. So I think that's positive. And then on the input side, it's all accommodative. Manufacturing inventory at 44, really low. Supplier deliveries have been inching up, which means they're struggling a little bit more every month. So all in all, I think we're in the trough here. I think we're at the beginnings of what will probably be an extended period in the trough. I don't see us coming out of this thing in the short term, but I would guess probably 3 to 4 months will probably break that 50 mark.
Well, what are the inflationary components in this report?
So the biggest one is prices, and prices contracted again, but not as much as they did in the month of July. We were down in the 42 or 44 range in July, came in at 48. So in the month of July, indicated that there appeared to be a price stabilization point that was being reached by buyers and sellers. I think we got awfully close to that in August. So I don't see a dramatic decline in the core stuff. We're probably going to be where we're going to be. The panelist companies are now in their business planning season for 2024. So there's a lot of arguments going on about what the price levels will be, lead times, delivery response rates for 2024. That's really kicking off now. We'll see how it all works out. But I don't expect any significant price declines absent, a major move on the Fed's part to constrict growth even further.
Tim, for my last question, what's the read-through here when it comes to margins?
I think companies are acting to protect margins. They have been now for several months, indicated this back in May. The only way they could protect margins is to lose people, and that's what they're doing. In the month of June, July, there was a few more layoffs and attrition. layoffs seem to be becoming more forefront. I think that was to prepare for Q3 and into Q4. But using attrition is a much slower way to get down to a headcount target. Freezes will be next, and then layoffs are the last resort. The layoff comments were not as prevalent in August as they were in July. So I think companies are feeling that with the current price structure on input materials, with a slow attriting down on the labor costs, they're going to hit a respectable margin target as we close the year, and probably more important position for 2024.
All right, Tim, always a pleasure. Thanks for quickly joining with us to break down this latest data here on the manufacturing front. Tim Fury, the chairman of the Institute for Supply Management Business Survey, walking us through there. So, John Tucker, looking over here at an interesting story that crossed the terminal. Billionaires' secretive plan to build a new city is backfiring. So a project backed by Mike Moritz and other tech billionaires, Fairfield Mayor has been lining up opposition among locals here.
Wait a second. Where's this new city?
San Francisco, northeast of.
Northeast of They want
Right.
to move out of San Francisco, build a new city so they can bypass all the problems that San
It's a
Francisco
great
is.
chart in here, this sort of map that you're looking at. California, mystery city under new scrutiny here.
This is like Xanadu, or
It's interesting here, going through the story, but California laws make it challenging for the developers to move forward, especially without strong support from the local community. It's kind of mind-blowing. This is not something that
I don't know.
was aware
Stories
of.
like this, for me at least, highlight the disparity in incomes. Like if you have the money, you can
right.
create your own little paradise somewhere, devoid of any reality whatsoever. So
I know. I feel like we living in New York. Well, wait, you are based in Jersey, of course, but I feel like when we
Xanadu,
talk about
to some.
we talk about sort of the cost living here, but when I think about California, this is a whole other level and pretty mind blowing here. But I mean, what do you think? You think you're going to go visit this mystery city here?
No, there's actually no chance whatsoever that I'll be there.
You're not interested whatsoever.
No interest whatsoever. It's just like, my travel plans are limited to like maybe within 50 miles of my house. So.
Right. I got it. All right. Well, John Tucker, there we go. We're going to do a quick check here on the markets because you do have the S&P 500 pulling back a little bit. Most of that due to we're seeing another rise in bond yields here, particularly the U.S. 10-year trading around 4.17 here. You're looking at the tech sector in the S&P 500 down about 0.1%. You have communication services down about 0.6%, but energy still up about 1.5% here. We'll have more coming up. This is Bloomberg. Now let's get a check on company news with Lisa Mateo.
Thank you, Jess. Two tech companies are heading in different directions after earnings. Broadcom shares are lower after delivering a downbeat forecast, while Dell is rising. Bloomberg's Ed Ludlow explains.
Let's start with Dell. The story is decelerating growth. Actually, revenue fell 13% year on year to $22.9 billion, but that was still ahead of Wall Street's expectations. Broadcom, a very different story. They're seeing pretty slow growth, the slowest top-line growth in years. But the narrative from executives is that the data center specific chips relating to AI are gaining traction and they're seeing demand. But realistically, you go straight to the outlook for $9.27 billion in the fiscal fourth quarter.
Now, that range of estimates from Wall Street were ahead of that figure on the bottom end and much higher on the top end. Look at the difference. Broadcom shares right now down 5%, Dell shares up 23%. And many consumers may be holding back on spending, but they still love their Lulus. Bloomberg's Steve Potisk explains.
Whether they're working out or not, apparently people want to look good. That's helping Lululemon Athletica avoid the broader retail slump. The athletic apparel company has lifted its full-year outlook as it takes business from competitors. Comparable sales rose 11% in the latest quarter. The results reinforce that shoppers, especially those at the higher end of the income spectrum, are opening their wallets for popular brands.
Now, shares of Lulu right now, they're up about 4%. And the Wall Street Journal is reporting that Saudi Arabia is considering selling a stake in Aramco of as much as $50 billion. It would be the largest offering in the history of capital markets. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. I forgot to turn on my microphone. S&P 500 right now, 8 points higher. That's up 0.2%, 45.15 on the index. The Dow Jones Industrial Average up 79 points. That's up 0.2%, 34,800 on the index there. And the NASDAQ 100, that has turned lower right now. That is down about 11 points. And more importantly, maybe the two-year yield, it is now higher. Remember earlier in the day, after the release of the non-farm payrolls number, it was seen as Fed-friendly. It was down about 10 or even 11 basis points. Once again, up 1 basis point right now, 487 on the more policy-reactive two-year. Energy, the best-performing industry group in the S&P 500. We have 7 of the 11 major industry groups. They are in the green right now. The biggest drag coming from consumer staples and consumer discretionary stocks. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess Menton.
John Tucker.
Laughing at me.
Hey, that happens to me all the time, too, turning on the button there. So this morning's jobs report, seeing employers adding 187,000 jobs in August. You also see the unemployment rate tick up to about 3.8%, but it had been hovering around 3.5%, about a half-century low for a while here. So I want to bring in Tom Gimbel, CEO of LaSalle Network, to break down some of these hiring trends and some of kind of a deep dive here within the data. Tom, thanks for joining John Tucker and myself this morning, especially on a slower Friday heading into the Labor Day weekend. What's your take when you are looking at some of these headline numbers? Because I know that the unemployment rate did climb a little bit to its highest level since last year, but is a lot of that due to more people just coming back into the labor force?
Yeah, absolutely. Participation rate increased a little bit, which is a good sign. And we had 187,000 jobs that were added, which is good. And you got to remember the prediction was 175,000. So we exceeded that. We're not over 200, but we are exceeding what the average jobs that were added between 2016 and 2020, which was 178,000 jobs on average. So it really signals it might not be the strongest economy we've seen in the past 3 years, but it's definitely not weak.
Now, I'm not going to give you an opening to do a commercial, but what does LaSalle Network do?
So we're a staffing and recruiting firm for white-collar jobs. So we do search for accountants, technology, sales, marketing, et cetera. And then we also have an interim or temporary staffing group placing people in those same fields.
Okay. Can you gauge for us how much they're getting paid, whether it's more the salaries are increasing or what? I'm trying to get a gauge of the inflationary components in all this.
Totally. Salaries over the past, during the pandemic, salaries increased the same way you saw it on the hourly side with Target and Amazon getting up into $20 and $25 an hour. It happened in the same thing within supply chain and marketing and HR and accounting and technology is always growing. And that continued really up until the end of last year. And then now we're sitting at a standpoint where it stabilized a little bit, where we've seen that the employee isn't in control the way they were in 2021 and 2022, where they could work when they wanted and demand whatever salary. And I think we see that by the labor force increasing and the unemployment rate going up, that companies are not in as much of a high demand as they were before.
What industries are seeing wage increases the most? I know you were talking about, obviously, technology and some others over the past year, but are there some less obvious particular groups there?
Well, I think it's really less about the industry and more about the roles. You could have somebody in technology that's working at a manufacturing company and they're going to get paid more. You could have a salesperson for a technology company being paid less because all the layoffs that exist. So I think it's really more about the individual roles of people than it is about sectors anymore. And that's usually what's happened since the Great Recession, is that it's been less industry. It's been industry agnostic when it comes to the recession, and more about the individuals and the roles that are in high demand. Cybersecurity continues to be super, super hot. You have healthcare that continues to be really, really hot, and people that are willing to do that, whether it be on the software and the technology side of healthcare. Remember 3 years ago, you couldn't find a nurse, pun intended, to save your life. And now we don't have that same problem. So things stabilize a lot quicker, and we just don't talk about that as much as we do when things are in short supply.
What are you seeing when it comes to sort of the work from home dynamic and some of the concessions that employers had been giving the past few years? Is there any sort of shift you're beginning to see happen here as obviously COVID begins to ease here?
Yeah, I think COVID has eased. I don't think that that's really the driver anymore. And what we're dealing with now is companies that are getting out front and leading. And I think what you'll see after Labor Day is more and more of companies that will be demanding people to come into the office 3 days a week and 4 days a week and the occasional 5. Now, there'll always be the outlier company that in order to recruit people will say, we'll let you work fully remote, but it's going to be few and far between. And I think on the big companies, you're going to see the majority of them, over 60 or 70%, they're going to have mandatory days in the office.
Is there a predictive capability to temporary help employment? What does it tell us about what businesses view of the economy?
Yeah, temporary help traditionally has been a leading indicator of when temporary wages and temporary staffing increases. It's companies putting their toe in the water following a recession or a slump in the economy, and that's how they bridge in. Now, what we've seen, there was an article in the Journal yesterday that said temporary staffing's lagging, which really lends itself to saying that the market's cooled down a little bit. I think it's really a different segment of that. I think that as unemployment and participation rates increase, that companies are able to find some people on their own a little bit more, a little easier. And that's an indicator. And we're seeing that people from the gig economy are now starting to re-enter the workforce. And the big one's going to be that we're still seeing, and I think this is an important indication, we're seeing temp to perm fees continue to be steady. And what that means is that companies bring in people to do temporary work, and then they'll pay money to buy out the agreement and bring them onto their payroll. And when that's happening, the economy's still strong because companies weren't planning to hire those people permanently, but they end up doing it. And that's a really strong indicator. And I still see those numbers as being on the strong side.
Hey, Tom, whenever you have particular economists who want to argue about a potential recession on the horizon in the next couple of quarters or just weakness in the economy, I mean, to your point earlier that you were alluding to, you still see that strength there. What do you tell them?
Well, I think the good thing about economists is they'll stick with their prediction even if it goes for quarters and years, and then they'll eventually have it happen and they'll say, I told you so, even though it was been going on for 3 years. And I think that's not real life. I think real life is that companies are hiring people. There's jobs for people that still don't have ideal backgrounds, which tells me it's still a strong economy. And it's not always about how much you pay somebody, it's are people willing to do the work. And we've gotten to a standpoint of entitlement in the country where we've got people that simply don't want to do jobs no matter what the dollar amount is. And that's where the disconnect is in our economic society. So I tell economists all the time, let's look at the companies that are hiring and the people that are taking the jobs and what the turnover and attrition rates are, and that'll tell you real things, but that's not captured in the BLS.
You talked about the sectors. What about the regions of the country? Who's doing what? Who's doing best and worst? And can you break that down?
Yeah, I think we're starting to see that, some of the policies and the regulations on the West Coast is really starting to affect some of that. And we've seen that, obviously, the moves of companies into Texas and Tennessee and other states. But we're seeing that if there's an area of the country where remote work is being offered more, it's coming out of California companies because a lot of people don't want to pay the taxes and have the regulation there. So we're seeing a lot more remote work there. It's easier to fire and terminate people who aren't working in the state of California. And I think the coasts aren't as desirable as they once were, sans Florida. So we see a lot of uptick in Texas. We see a lot of it in Tennessee, which are, there's big growth areas in Austin and Nashville, and those tend to be really, really strong. And hiring in the South, the traditional, I call it the SEC South, from Alabama over to South Carolina, tends to be strong areas for small to medium-sized companies.
Tom, we only have about 30 seconds left. What's some of the top questions or concerns you hear from employers?
Oh, I think the biggest thing is, we're going into an election year. So there's less concern thinking that DC will want to have the economy humming going into it. But the biggest challenge that they're feeling is that of concern is if the overtime exemption salary is going to increase, what they're talking about, from 30, I think it's 38,000 to 54,000, and that'll be something that could really hurt if inflation doesn't settle down and having to pay overtime for people at entry-level jobs.
Well, Tom, thanks so much for joining us. Always a pleasure. Tom Gimbel, CEO of LaSalle Network, breaking down what's happening with the jobs picture and hiring. Quick check here on the markets. Looking over at the S&P 500, up about little less than 0.1%. NASDAQ 100 virtually unchanged, and the Dow up also about 0.1%. Let's get a check on world and national news with Nancy Morris.
All right, thank you, Jess. President Biden is now asking Congress for $16 billion in disaster relief after the wildfires in Hawaii and the hurricane in Florida, which is up from the earlier request of $12 billion on top of another $28 billion. The president wants to assist Ukraine and boost border security. More on this now. Bloomberg's Jody Schneider standing by in Washington.
He called on lawmakers yesterday. He was visiting the FEMA headquarters. His quote was, "We're going to need a hell of a lot more money to deal with while you're taking care of us." He spoke to the FEMA employees. When lawmakers get back next week, it's really going to be a budget discussion all the time.
Bloomberg's Jody Schneider in Washington. President Biden, meanwhile, heading to Florida tomorrow to survey the damage from Hurricane Idalia. Homeland Security Advisor Elizabeth Sherwood Randall says they took swift action to get those boots on the ground.
There are currently approximately 1,500 federal responders on the ground in Florida.
She says the president is prioritizing the recovery efforts. Record numbers of migrant families have crossed the U.S.-Mexico border in August. Now, data obtained by the Washington Post show Border Patrol arrested 91,000 migrants who crossed as part of different families last month, exceeding the record set in May of 2019 of more than 84,000. Border apprehensions have actually risen more than 30% for 2 consecutive months. The Los Angeles City Council is furious with Texas over a migrant busing program that brought 400 people to the city. One Democratic councilman wants to know if charges of kidnapping or human trafficking could be pressed. Meanwhile, Massachusetts Governor Maura Healey is activating the National Guard to help provide basic services at some of the hotels being used as emergency shelters for migrants. Healey declared a state of emergency over the migrant crisis in Massachusetts earlier this summer. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Jess and John.
Thank you, Amy Morris, not Nancy Lyons. It's the end of the weekend. I'm not as good.
Amy's a pro because she just picks it up, doesn't even
she just goes.
She just goes.
Combine both their names.
So it's just like she knows how it works.
Well, Molly Smith here in studio
right.
from our economics team at Bloomberg News. I hear you're going to be joining Carol Masser and Tim Stenovic later in the afternoon, the two hosts from Bloomberg Business Week, of course. On
we need a U.S. Open update because Molly's background. Explain to everybody. You were a tennis star at Syracuse, right?
I did. I played tennis there in college. Played mixed doubles in our club team throughout college, and play in a few USTA leagues now. So normally I go to the center in Flushing when it's empty during the rest of the year to play out there. But it's been an amazing.
What's the update? Who's winning? Who's losing?
Yeah, give us Looking at the men's and women's.
Yeah, I mean, I think no like enormous upsets so far. Like I think like most of the top seeds are still cruising pretty easily. Alcaraz on the men's side won pretty handily last night. I'm sure Djokovic will do so later today. Yeah. John has no idea who I'm talking about.
I can't pronounce any of these names.
The women's side, here, do you want to give it a shot at the women's number one?
I'm not going anywhere near there.
Iga Swiatek, she's looking good, as well as the other top couple of seeds up there. The only big one so far has been Stefanos Tsitsipas on the men's side. He's a top 10 player and went out to a pretty young guy who's really had, I mean, Stefanos has had a pretty rough season, and he fired his coach pretty immediately right after that match. A guy who he's been with for less than a month, so it's not been a good season for him.
Can a normal schlub go out and watch tennis at the U.S. Open?
I would encourage them to. You absolutely should. No, but I mean,
it's too expensive, right?
Oh, I thought you meant for the entertainment value. But,
well, that's But
well, yeah, it is expensive. I've seen some grounds passes now that you could buy for like $250 on Ticketmaster versus at face value it's like $100.
Yeah.
I mean, I will say it is. I still think the best value in all sporting events. You know, the gates open. What you can come up there in like 10 or so in the morning, first match on at 11. Ooh. You can stay all day. I've been there till 10 o'clock at night. No one's kicking you out.
But you're going to have to pay extra to see the big matches in like Arthur Ashe Stadium.
Yes.
Otherwise, if you're like me, you could walk around and see people you've never heard of in the tennis courts. They're like a mile away.
Well, it's all still, it's not that far. It's still, I mean, the grounds are huge, but they're all like, you know, pretty well contained. But yeah, I've been doing the same thing, John. I haven't been going into Ashe. I think the action on the outer grounds is like way more of the bang for your buck, especially because the top seeds are playing, like you said, relative nobodies in the first week, and the matches aren't particularly competitive.
So you'll be there all weekend?
I mean, I'll be there this afternoon with Carol and Tim, as you said. So our Bloomberg Business Week radio show's on site to this afternoon.
I love that.
So I'll be there, and maybe we'll even talk about the jobs report, which is my actual
maybe
job.
that'll come up, but I feel like y'all have more fun doing the tennis.
Is that why you came in here to talk about
Oh, that's right.
Report?
There was other things that she was...
No, that's okay. We can stick with this.
I guess we should quickly get some of your thoughts here on this morning's jobs report. John and I have been talking about it all day with some of our guests, as you know, but what's your sort of view here?
Yeah, I think this is it's one of those reports that kind of gives a little bit for everybody. I think this points to that gradual cooling in the labor market that we've been hoping for, that, payrolls gains are moderating. This one did come in above forecast, but as we saw the downward revisions to the prior 2 months, that's a pretty consistent trend. So wouldn't be surprised if this one gets revised lower when we get next month's print. And, we're seeing more people come off the sidelines, which is really helpful, especially in cooling wage gains.
Right. So how much did that also impact the unemployment rate rising?
I think that was pretty much entirely it. So when you look at why the unemployment rate would rise, this would be a, quote, good day for that. It was pretty much all because of labor force participation coming up, not necessarily because so many more people were actually unemployed.
So it's a little bit lighter next week on the eco counter compared to the past couple of weeks. I know we obviously have CPI on September 13th, but what are you looking ahead to next week?
Oh boy, I didn't even look at next week's calendar. I'm thinking about the quarterfinals, honestly.
I know we do have like consumer credit. There's a number of Fed speakers coming up. So John Williams will be speaking. Susan Collins too is on the calendar. And then also Jim Bullard will be speaking. Obviously not at the Fed anymore, but still a very influential voice there whenever he speaks. So
and I wonder who's going to replace him.
Right. It's going to be really interesting.
That search really gets underway. I mean, I'm sure the Fed speak will be interesting. We haven't heard of... I don't think anyone's spoken yet coming after the jobs report, so it would be nice to hear some fresh voices on what they think of all of what happened this week, also with like the job openings data and the JOLTS report from earlier this week. I think it's largely that, the stars are really aligning for the soft landing camp.
Yeah.
Why don't we put on your thinking cap, because I want to go to the 2-year. It's been a round trip. I mean, after the jobs report this morning, about 8:30, we saw a decline in yields of like 10 or 11 basis points. Now it's up a basis point. We're at 487. I don't know. It's just like, what happened?
You know, there's this word we love to use when we're writing the market reaction. It's called fluctuated.
Oh, yes. Comes up a lot. I know what you're talking about.
It does tend to happen. So I think that would probably be our word of the day today, that it's probably at first.
Actually, we've been trying to use Goldilocks as every time someone says it, we're doing a shot count for John Tucker and myself.
Okay.
So you can get that
That's
in.
our drinking
We're about,
game
what,
for
7, I think? We're around 7?
Yeah, no, 7. We tried to get our last guest to do it.
She wouldn't say it, though.
She used a different
We
metaphor
basically asked her if she avoided it.
Well, maybe that's why you mixed up Amy and Nancy's names.
That's probably
It's
what it
getting
was.
Too high.
It's starting to make sense here. But yeah, I mean, also next week is the last week we'll hear from Fed speakers before we get the blackout week.
Yep.
So it's kind of like we got to expect all of them to kind of come in, get their hot takes, and then we won't hear from them for then another week until that the September 20th decision, which obviously comes with the economic projections and, of course, the dot plots. So what are you thinking there? Because obviously those do get adjusted quarterly.
Yeah, no, I think we still haven't had that second rate hike that the June SEP had projected. So we had one of them in July, and it's a TBD when that second one could come, if at all. So I think right now consensus is still leaning toward September being unchanged, that rates would be held steady, and it seems like today's report would reinforce that opinion. But it's still a bit of a question mark for November, so too soon to roll that one out.
All right, Molly Smith of Bloomberg News joining us in studio. Not many people here today, so it's always great somebody
Friday.
here. And now let's get a business flash with none other than John Tucker.
All right, let's go right to the equities. We are pairing the earlier gains. In fact, we're seeing losses right now. The tech-heavy NASDAQ down 30 points. That's down 0.2%. The 2-year yield, 1 basis point higher at 487. That's because of fluctuation. Oh, please. S&P 500 up a point. The Dow Jones Industrial Average, 42 points higher. That's up 0.1%. Seeing shares of Apple, one of the leaders in the S&P 500 right now. On the other side, you see some of the mega cap tech names. Tesla, that is down 4% right now. That accounts for about 3 of the index points. NVIDIA shares, those are down 1.8%. Then you have Broadcom down 5.6%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
Jess Mitten, John Tucker here, still in the Bloomberg Interactive Brokers studio.
We're biding our time in a way for the President of the United States.
We to speak about the jobs report. He was supposed to speak about almost
I don't know if
half
it's
hour ago.
What do we call it? A victory lap? Or does he want to address this jobs report when the unemployment rate, which is kind of like the headline number that they look at, that actually increased?
But it was due to more people coming back into the labor force.
Which is a good thing, I guess.
Yes.
All right.
But it is a little complicated when you do unpack all of the numbers. But I want to get straight to Jan Ellis, Director of Affiliate Development at Jobs for America's Graduates, who's joining us on Zoom to talk about these job prospects for students that are heading into the new school year here. Talk to us, Jan, about kind of what you're seeing as we are going into a new school year here and what this means for graduates at this point.
Yeah, thank you, and thanks for having me. So let me start really quickly just what JAG is, Jobs for America's Graduates. We work in nearly 40 states across the U.S., urban and rural environments, to provide young people with the skills to succeed in the workplace and in life beyond high school. So we're teaching them critical skills that are in demand by employers, such as communication, problem solving, and collaboration, skills that we know employers need, right? And so thinking about the recent job report, this is a good outlook for our young people, especially if we're looking at sectors such as healthcare, construction, continue to grow, and the recovery of hospitality and leisure. These 3 sectors offer our young students and graduates opportunities with lower barriers to entry to get that job and a career path opportunity in a sector that matters.
Do students at that stage of life really know what they want to do? I mean, I look back to, I don't know about you, but I look back to college, and there's not a damn thing taught me that I'm using.
Really?
I mean, that's
when I
not to say-
graduated, my goal was, hey, I want to be a markets reporter at Bloomberg.
Really?
Yes.
Oh, Lord.
Worked out.
Well, so
Okay.
JAG is perfect. JAG's the perfect solution for that. What we do, not only in including preparing those young people with those skills, is we conduct hands-on career exploration with employer partners. And that can be in person in a classroom, in person at a facility or an office building, or it could be online, virtual. And we're connecting our young people in classrooms and other environments with employers like Boeing to learn about aviation and advanced manufacturing, or with HCA Healthcare to learn about all the opportunities in the healthcare industry. And so they can learn how they can be a medical assistant and maybe work their way up to a nurse. So you're right, young people don't necessarily know, but our role is to provide them the platforms to learn so they can make informed decisions and not really waste idle time taking the wrong college classes. Or maybe they can avoid college and go straight into a career.
Hey, Jan, you were talking about the regions where your firm obviously has exposure to. Where are you seeing some of more of the jobs growth and gains there versus others that are having hurdles at this point?
Yeah, great question. So certainly in our rural environments, it's a little more challenging because there's fewer employers, right? There's fewer opportunities. Those opportunities aren't as diverse as, say, a young person looking for work in a metro area, like maybe it's Detroit or Los Angeles. So I'd say we're challenged in the urban or in the rural environments. However, if you're a high school senior and you're in that rural environment and you're interested in a career opportunity that maybe isn't offered in your area, we have those virtual platforms where they can learn and they can explore. And then when it's time, they can go do that in person if they choose to leave their area.
How much do you focus on the trades?
So we do focus on that, and then that's locally. So the way that we're set up is we're an affiliated network. So in those nearly 40 states, we have independent affiliates who operate the program locally. And so they're connecting every day with the trades. Maybe that's construction trades, manufacturing, and they're getting those employers and those training providers into the classroom, into the community center to teach those young people about those opportunities. And additionally, we also connect our young people in those local environments with the military. The military definitely provides skilled trades training, opportunities for young people, and that's obviously free and they get paid to do it.
Hey, Jan, what's been the biggest hurdle coming out of the pandemic for new graduates when they are trying to get jobs? Because the last few years have been obviously very wonky, just given COVID.
Yeah, I think it's the adjustment. I think it's the adjustment going from being, isolated to now, the economy, their world, the young person's world is fully open now. So it's making that adjustment to say, okay, I can leave this small area that I've been isolated in and go explore. So I think it's the mental adjustment to say there's a lot out there and it's okay to go out and try to seize on it.
Just this morning, believe it or not, I got a message, an email from the Department of Education about my kids' student loans, informing me, the parent, that the time to start paying is coming up. How does that impact all the kids you deal with?
Yeah, so predominantly the young people that we're working with, they won't have student loans yet. However, when they graduate high school, if they're going the post-secondary route, i.e. college, they may get those loans, right? So in our program, we're exposing them to opportunities for career pathways that may not necessarily require student loan or may have ways to mitigate student loans. So healthcare is a great example. Manufacturing is a great example. If you look at specific employers need talent so badly that they're paying for training. So that's a way to mitigate or completely get rid of the opportunity to take on student debt.
All right, Jan Ellis, Director of Affiliate Development at Jobs for America's Graduates. Thanks for joining us. We appreciate your time. Always a pleasure. I want to bring in Steve Matthews as I'm sure our listeners know his byline from Bloomberg News. He covers economics here. And we did get clearly the jobs report. We've talked so much about this, John Tucker and myself this morning. Also, when it comes to that ISM manufacturing data that showed some resiliency a little bit there. Obviously, there's been some problems when we're looking at that side of manufacturing. With this batch of data, what do you think this is sort of pointing the picture to for the economy ahead of the Fed's decision later this month?
Well, I think, the clear trends are for the labor market, there has been a gradual cooling. I mean, you had 187,000 payrolls, which is a very solid number, but the unemployment rate went up because there was a big increase in the labor force, a lot of people entering the workforce this past month. And wages, the average hourly earnings was a little bit lower than expected. All in all, what you're seeing is a pattern that there's some cooling in the labor force. More people are entering the labor force. Wages are not as hot as they were at one point. So that gives the Fed pretty much a green light to pause in September. There's reason to believe that they will at least retain the option to hike later in the year. They have two meetings after the September meeting. But, absent there being some disaster, and we'll get the Consumer Price Index report, I think it's September 13th, which is just,
That's correct.
not too far away. But absent some disaster there, we're going to get a pause.
Jess, it sounds like Steve Matthews is saying Goldilocks to me.
Ooh, maybe we should tell him about. I don't know if he's been listening this morning, but please
take another
say
shot.
So it is a Goldilocks report. Yes, absolutely.
Not too hot, not too cold. But everyone forgets there are bears in that story too. What did I miss out on the rates, the 2-year especially, putting all my money there? I mean, what's the outlook the market is saying when we take into account all this data and the projections from the Fed?
Well, it's interesting because, the initial response to the jobs report was very positive in terms of, there was a lot of belief that, okay, maybe the Fed is done. And then we got, the ISM report, and we've seen, some rebound in yields. And the view of Fed watchers is the Fed is not done. What the Fed is worried about, the Fed's goal has been to get a slowing economy. They want to see below trend growth. The trend rate for the economy is about 2%. They want to see the economy growing less than that so that there's less long-term pressure on prices. And they're not getting that. I mean, if you look at the Atlanta Fed's GDP tracker, GDP now, it's, I think, at nearly 6%. So, and if you look at the internal details of this jobs report, you see average hourly, you see the number of hours going up. And so there's reason to believe that there's still a kind of a booming economy, definitely in this quarter. And the Fed wants to see, below trend growth. So they're going to retain the option to hike later.
And they want to get to 2% inflation. Is that going to be adjusted at any point? What's 2%? I mean, it sounds like something that somebody came up with on their secret decoder ring.
New Zealand in the 1980s started that one.
They have 2% came up with from Ben Bernanke. There had been an implicit 2% target even before Bernanke formally announced it, and it's kind of been the international standard. I mean, if you look at countries across the board, they're using a 2% standard. The Fed has no interest in, as Chair Powell said last week at Jackson Hole, there's absolutely zero interest in changing the inflation target. And it's like you see online and people give op-eds about, oh, let's raise the inflation target to 3% or whatever.
Right.
No, that's not going to happen. It's just it's a fiction.
Right. All right. Steve Matthews, thank you so much for Bloomberg News, covers economics for us, coming and chatting with us this morning. We appreciate it. Now let's get a check on world and national news with Amy Morris.
All right, thank you, Jess. More than 3 weeks after a wildfire devastated Maui's historic town of Lahaina, Hawaii's Governor Josh Green says they've opened several investigations into people who are trying or allegedly trying to buy property there. Now, that's a violation of a new emergency order. The governor says they've enhanced the penalties now for anyone found guilty of that violation.
We want to keep this land in the hands of local people, and we want to give them at least a chance to decide whether they'd like to build back.
Meanwhile, the number of people missing is expected to fall into the double digits. An update on that's coming later today. President Biden is requesting an additional $4 billion in disaster relief from Congress after Hurricane Idalia and the recent fires in Maui. The ask substantially increases the cost of a sweeping emergency package requested by the White House just weeks ago. The Office of Management and Budget says the administration is now asking for a total of $16 billion, quote, given the intensity of the disaster activity around the nation. And the proposal faces a difficult path on Capitol Hill. U.S. hiring picked up by 187,000 in August. That number would have been higher if not for strikes by Hollywood workers and the bankruptcy of trucking firm Yellow Corp. A threatened strike by the United Workers Union could also hurt future employment reports. We talked about it with Acting Labor Secretary Julie Su about the UAW negotiations and if the administration would support a 46% raise for employees or a strike that could affect 150,000 people.
I think it's premature. I think the contract is not yet expired. It's important to allow the parties to do what they want to do. One of the pillars of Bidenomics is an empowered workforce is a good thing for working people, and that is something that he's been unwavering about.
Acting Labor Secretary Julie Su speaking to Bloomberg Radio and Television. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg. John and Jess.
Thank you, Amy Morris. We appreciate it. Jess Minton.
Who's in the office,
Yes.
along with Jess Minton and
John Tucker.
Here in person.
Coming up, President Biden is expected to speak about the job market, so stay tuned and listen in for that. John Tucker, I know there's a story you were eager to talk about, looking at how fewer than half of all office workers are back at their desks.
Yeah, I mean, this is nationwide. We should point out there's a company out there, it's called, Castle Systems. They track the data when you badge into the office, and they can tell from that. They extrapolate from that just how many people are. Nationwide, it's only about, it's less than 0.5%. And in New York City, it's even lower than that. So as we have firms like Goldman Sachs telling everybody, you got to get back 5 days a week, and firms like BlackRock telling people they got to be in, I think it's like later this month, at least 3 or 4 days a week.
You know who's really bullish on in office? Paul T. Sweeney.
Who just happens
isn't here
to be
today.
off today.
Happens
But anyway,
to be
that
off
gives
on
you an indication. It's
the
just
final
like,
summer Friday.
and there was also a survey along with this that pointed out that a lot of the people who are still working from home, the majority of them said if they were required to come back into the office 5 days a week, that they would quit. And
Really?
in this labor market, we'll see whether or not that's just
they're
tough
able to do
talk
that.
or whatever.
Yeah.
So
It's a complicated dynamic there.
that's your insight.
It is. I mean, obviously, eventually at some point there will be a recession, whether or not it's in the, and that will shift the dynamics there to where people will be
Anyway, it's
coming
a
to the
pleasure
office. Not
being
saying
with
that
you
it is
today.
coming soon, but eventually in a business cycle it will happen,
Just, I
and
just
people
want
will
to
have
put
to
out the
start
warning
coming
out
up.
there if you're near the Lincoln
I have
Tunnel,
to say though
pull over,
quickly,
'cause I'm coming.
John Tucker unfortunately is leaving us, but it's been a pleasure. Simone Foxman's coming up next with us, so hey, everybody stay tuned. But thank you for doing the last 2 hours.
That was
More
great.
with
That was a lot
Bloomberg
of fun.
Markets starts right now.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Jess Minton and Simone Foxman
Hi.
here in the Bloomberg Interactive Broker Studio. She's back. She was here a couple hours ago, so she's up next with us for the next hour. Of course, as we know, Matt Miller, Paul Sweeney do both have the day off, so stick with us over our final hour for Bloomberg Markets. We have Jennifer Lee of Bloomberg Intelligence joining us to talk about the FTC's settlement on the Amgen Horizon deal. Also, Eddie Vanderwalt from Bloomberg News on the latest with the jobs data, and Martha Heller from Heller Search Associates on the outlook for tech hiring. But first, let's get a business flash with Charlie Pellet.
Hi, thank you very much, Jess. Here's what's going on. Jobs Friday, those earlier gains have fizzled. Now in the red on the S&P at 4503. Going to be very interesting to see whether we end the week and head into the weekend at above or below 4,500. Down 4 points now, down 0.1%. The rally is sputtering. We've got the Dow holding on to a 10-point gain, little change there. NASDAQ, the composite index, down 46 points, a drop there of 0.3%. A slide in some mega caps is weighing on stocks, which erase gains that were earlier driven by bets that the Fed is close to ending its hiking cycle. Non-farm payrolls rose 187,000 after the prior 2 months were revised significantly lower. The unemployment rate rose to 3.8%. Reaction to the jobs report from Ben Emmons, the head of fixed income at New Edge Wealth, who was a guest right here on Bloomberg Markets.
This is a jobs report where if you're seeing that many people getting pulled into the labor force, which is like 730,000 or so, it tells you that the labor market is quote unquote in demand from people wanting to really get back to work, to try to make more money. And that's good for the economy, right? That's productivity. That's actually a very positive sign.
And you can hear more of that conversation with Ben Emmons on the Tape podcast. You can download it wherever you get your podcasts. Dell shares soaring by 21.7% after reporting better than expected sales of PCs and data center hardware. Broadcom, a supplier of chips to Apple and a broad swath of the tech industry, falling on a bearish outlook. Shares of Broadcom down now by 6.2%. And Lululemon Athletica higher after lifting its full-year outlook as it takes business from competitors and defies the broader retail slump. Lululemon up now by 5.5%. Again, recapping, early gains have fizzled. S&P right now down 6, a drop there of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Bloomberg Markets is now on YouTube. Watch us every weekday starting at 10 a.m. on your TV, computer, or smartphone. Just visit youtube.com and search Bloomberg Global News. Simone, such a pleasure having you for the final hour here.
Pleasure to be here.
Busy week. I know it has been. And even though it's been obviously seems like a slower day heading into the holiday weekend, of course, Labor Day with the markets closed on Monday, still waiting for a speech from President Joe Biden on that latest jobs data that we could get this morning. So we're staying tuned for that. But first, let's get a check on what's going on some individual names here with Carmen Renicky, one of our star reporters on our U.S. equities team. What are you watching?
Yeah, thanks, Jess. Well, first thing that we're watching here, Dell Technologies. So it's been up as much as 25%, reaching a record high after reporting better than expected sales. This is also getting an AI boost, the buzzword that we've been, hearing about in the markets. The analysts were pleasantly surprised by what the firm is seeing so far in its sales, and it's something that the company is calling a long-term tailwind. So artificial intelligence, helps another stock soar again.
Yeah, I wonder what the timeline is there to kind of bring in AI. How much does Dell become an AI company? Even though it seems like there's also a bit of enthusiasm about what's happening in, PC sales, like some of the consumer and even enterprise side.
Yeah, so the the PC sales thing is really big, and it's definitely sort of signaling that there might be a recovery in those.
This is an interesting report because it really shows you very clearly what's happening in certain industries. We saw truck transportation lose more than 36,000.
What other stocks are you keeping a close eye on?
So the next one that we're looking at is
we also see signs of the Hollywood strike in this report, with more than 16,000 jobs lost in the movie industry.
48%. It's paired much of those gains. I think it's last up about 16%. And this is because the U.S. Energy Department announced that it is offering the company a conditional loan guarantee. Basically, this is a nearly $400 million loan that the company can use to expand. It looks like it would use it for production lines for batteries. And a few analysts lifted their ratings on the stock following this news.
Interesting. You also have been covering pot stocks this week that have been on a tear. Give us some background as to what has been pushing these shares higher.
Yeah, so the MJ Pure Play Index, which is an index that's tracking sort of the broader industry, is up as much as 30% this week, on track for its best week since 2020. Basically, earlier in the week, the DEA said that it would review the schedule for cannabis, meaning that it could move it from a Schedule 1 drug, which means it's ranked the same as heroin, to a Schedule 3, which puts it more in line with things like anabolic steroids, testosterone, and ketamine. This would be a huge change for the industry. It would mean that legal cannabis companies in the U.S. could get some tax credits and deductions that they've been banned for. It also may open the door for further research on the substance.
Well, and, banking, too, because the Safe Banking Act has not really gotten kind of the enthusiasm from congressional leaders that they have wanted.
Exactly, and it's something that they're kind of hoping that it will get the bipartisan support to go forward this year. It was on the floor last year and, didn't go to a vote. So that's a huge deal for this industry, and it's also a huge deal for the stocks that have kind of been, without a catalyst for a long time. So investors are really excited about that. It's also important to note, though, that even with these jumps that we're seeing this week, these stocks are far from their highs in 2018. So
I have to say, looking at the Round Hill Cannabis ETF, the ticker symbol is weed on that, up 45% this week.
Yep. It's
Wild
the best week
move
ever
there.
for that ETF.
Well, it looks like Trees Corp is up 53% today.
Yeah. And Tilray, ticker symbol TLRY, weekly gains 25%.
I know we've got to jump not too long from now, but Walgreens, some big changes there.
So this was really interesting. CEO Rosalind Brewer stepping down after less than 3 years at the company. In a statement, they said it was a mutual agreement, but it's a really short tenure for her, and she was the only Black woman serving as the CEO of an S&P 500 company.
Oh, really?
Yeah. Yeah.
So a troubling move there. But I know that Walgreens, as well as CVS, frankly, have been trying to push into the healthcare space.
Yes.
But this seems much easier said than done.
Exactly, and it seems like that was something that Brewer was really looking to have more progress on in her tenure as CEO, and maybe just wasn't able to get the progress that the company was looking for.
Yeah, and those shares falling about half since she took over for the helm there. So pressure.
The lowest since 2009.
Right.
Yeah, wow.
I know you also cover short interest for our team too. What are you seeing? Any sort of trends there when it comes to that with what you've been reporting on recently?
That's a good.
Anything that's
that's a
stuck
good
out
question.
to you?
So,
because I know Tesla is always the hot name that's on there, so not surprisingly. But I know there are some tech names typically on those lists too that people keep a close eye on.
So the thing that was really interesting that I was looking at was actually that August was a pretty good month for short sellers. This year hasn't been great, right? Because the market's gone up, a lot of stocks have rallied. That means that short sellers are getting burned. But in August, even though we did see a little bit of a bump in the last week, short sellers were actually able to maybe take some profits in some of those stocks, such as Tesla. I know Upstart was big on the list as well. So that's interesting. I mean, it's been, not the best year for people on the short side of the trade.
Right. How does earnings season impact when it comes to the short selling versus, say, we already got through the thrust of it, right? So we don't have the banks reporting until mid-October. Yeah. So is there a difference, say, when you see what things could potentially look like in September versus, say, the height of earnings season or even heading into an earnings report?
I mean, I think that, earnings is obviously a huge catalyst for stock movement, and so short sellers are also probably positioning around those reports, right? If they think that there's going to be a miss, maybe they're adding to that short side. On the flip side, if they think there's going to be beat, maybe taking away from that. So I think in kind of the interim, there's a little bit of like repositioning that can happen, and sort of looking ahead and seeing what is the next thing. I think the other thing is in September, we get more volume, people are coming back, there's just more action that's happening.
September's supposed to be the most, on average, the most negative month of the year, too.
It's interesting, too, because Bank of America strategist pointed out that because you use SEAG Go in the terminal, and that's where you can see that weakness. But they were talking about when you do have years like this, when you have a really strong first half, typically September doesn't tend to be quite as weak as it typically is. Obviously, things don't always happen to this historical pattern, but to Simone's point, August, September, typically the weaker months of the year. And we did see the bulk of that happen the first half of August. So kind of wondering, whenever you're talking to your sources, how are they thinking about positioning in September?
Yeah, I mean, I think that we will probably see a lot of the same trends that we've seen in August. People are really betting against those really high-flying stocks. Tech names are huge on the list. And then a lot of the AI names are up there as well, right? Those stocks have just seen such a tremendous run. People are really betting that they're going to see some weakness, especially, as you mentioned, going into the next earnings season. We might start hitting the point where people can't really just bank on excitement. They have to really start showing that there are results, that this can drive profit. And if they miss on those expectations, that could send shares lower.
What other names typically pop up on some of the short interest lists? Because we talked about Tesla, but then do you have like the high flyer names too? Not surprisingly, like Microsoft, Apple, other names like that typically on those lists.
Apple is definitely a huge one. I mean, the biggest companies also are generally high just because they have a lot of shares outstanding. It's easier to find stock to borrow, and then people are also hedging positions, right? Let's see what else. Meta is a big one. Palantir is actually top of the list for one of the most profitable shorts in August. Plug Power, Rivian. That kind of gets into some of the more meme retail favorites are often ones that short sellers will bet against.
What was interesting with Palantir you bring up? I found there was a report out from Morgan Stanley talking about, I believe, how the valuation was just overplayed, which is so funny because earlier this summer we were talking about how this artificial intelligence platform, AIP, was going to be this sort of panacea for governments, able to use AI on the battlefield, and that was going to be this huge driver of profits. And they saw a lot of excitement around it. And then, we got these disappointing earnings of like, we're not going to get the same kind of sales growth as everyone had anticipated, and the shares have really taken a hit on that too.
Yeah, it's true. It was one that had a huge run up right ahead of earnings, and then it just didn't deliver. So it really goes to show how if you aren't showing a clear path to profitability, that AI, isn't necessarily going to be sort of like the panacea for earnings or your stock going forward.
All right, Carmen Renicky, one of our star reporters here at Bloomberg News. We appreciate you getting all things here when you're looking at those individual movers. I want to move over to another Bloomberg News reporter here, Eddie Vanderwalt, who's joining us to break down what we're seeing when it comes to, obviously, the jobs data that we saw this morning, as well as just kind of more globally when you're looking at how the U.S. economy is performing versus Europe's, as well as some of these slowdown signs again brewing when it comes to China. Eddie, always a pleasure getting your thoughts here on the markets. We've talked so much about the jobs report this morning. I kind of want to just get your thoughts. What are you watching, and what do you think this really tells us maybe from a more global perspective about the economy when you look at the U.S. more towards its counterparts here when you're thinking about Europe as well as China? I think we may have had just a little technical glitch with Eddie, so we'll work on that. Can
I bring up something that Eddie wrote, though?
Yes,
maybe if he comes back, he can join us. He writes for the RM Live blog that higher participation rates should help stocks here. So an uptick in the participation rate may well be the most meaningful for inflation, in part because workers returning after the COVID era. More workers means less pressure on wages and thus on policy members to hike rates. So kind of an interesting analysis as we frankly, he put this out at 8:39. So quick response to some of these data coming out at 8:30 this morning.
Right, especially when it comes to Eddie, as well as a lot of our reporters that are on our MLive, TLive surveys here. And I hear that we were able to fix the connection, and I believe Eddie is back with us. Actually, we're going to quickly, before we get to Eddie, now we're going to head to Washington, D.C. to hear from President Biden. He's discussing the August jobs report, so let's head over to him right now.
One of the strongest job-creating periods in our history, in the history of our country. It wasn't that long ago that America was losing jobs. In fact, my predecessor was one of only 2 presidents in history who entered his presidency and left with fewer jobs than when he entered. Look at where we are now. Just this morning, we learned that the economy created 190,000 jobs last month. All told, we've added 13.5 million jobs since I took office. Around 800,000 of them manufacturing jobs. We created more jobs in 2 years than any president ever created in a single four-year term. We did it in 2 years. What's more, when I took office, the unemployment rate was 6.3%. The nonpartisan Congressional Budget Office predicted that it would not get below 4% until the end of 2025. Now, the unemployment rate has been below 14% for the last 19 months, the longest stretch in over 50 years. We've recovered all the jobs lost during the pandemic. We've added 1 million more new jobs. More than 700,000 people joined the labor force last month, which means the highest share of working-age Americans are in the workforce now than at any time in the past 20 years. People are coming off the sidelines, getting back to their workplaces. Job satisfaction is higher than it's been in 36 years. We've seen record lows in unemployment for African Americans, Hispanic workers and veterans, and workers without high school diplomas, and the lowest unemployment rate in 70 years for America's women. At the same time, inflation continues to fall. It's now around 3%, about 1/3 of what it was 1 year ago. In fact, we learned yesterday that over the past 3 months, inflation was close to what it was before the pandemic. And incomes are higher now than they were before the pandemic. While pay for low-wage workers has grown at the fastest pace for low-wage workers in 2 decades. Remember, some experts said to get inflation under control, we needed higher unemployment and lower wages. But I've never thought that was the problem. Too many people having a job, or that working people were making too much money. And now, after months and months of bringing inflation down, while at the same time adding jobs and growing wages, it matters. And it's no accident. I came to office determined to build the economy in a different way, from the middle out and the bottom up, not the top down. To move away from trickle-down economics and instead focus on the middle class. Because when the middle class does well, and this is not hyperbole, when the middle class does well, everyone does well. Everyone does well. The wealthy do very well, the poor have a shot, and the middle class can make a living. The Financial Times and the Wall Street Journal, have heard me say it before, started calling my plan Bidenomics. It's about investing in America and investing in Americans. It's working. A key pillar of Bidenomics is empowering and educating workers who are the backbone of this country. I want to mention a few actions my administration took this week to support workers by raising workers' pay and helping more workers get good-paying union jobs. First, we proposed a new rule to extend overtime pay for up to 3.6 million workers across the country, additional 3.6 million. And here's why that matters. Until now, salary workers who were not paid by the hour were often not guaranteed overtime pay unless they made less than $36,568 a year. That was a threshold. If you were a fast food manager or made even $1 more in salary, you were not guaranteed overtime pay, even if you worked an additional 40-hour week. The new rules we proposed this week, raised that threshold to $55,000 a year. That means a mom in North Carolina who makes $37,500 a year as an executive assistant and sometimes works a 60-hour work week could now be guaranteed time and a half whenever she works over 40 hours in that week. Plus, moving forward, that salary threshold automatically will update every 3 years so that it stays up to date with wage growth and purchasing power. What would make it easier for workers to earn overtime? In the future, it would. The automatic update was something we did in the Obama-Biden administration. My predecessor scrapped it. We've worked to bring it back, and it'll make a big difference for a lot of American families. Next, thanks to the Inflation Reduction Act, which I might add not a single member of the other party voted for, we're making the most significant investment in clean energy and combating the existential threat of climate change that's ever been made anywhere in the world. According to outside experts, the Inflation Reduction Act is projected to create more than 1.5 million jobs over the next decade, which I said when I was writing the legislation. This week, the Department of Treasury and the IRS announced guidance on new tax incentives for companies that invest in clean energy, like building wind turbines and installing solar power. In the previous administration, companies got a tax cut. And they could go wherever they wanted to, including overseas, and hire whoever they wanted in order to get that tax cut. But on my watch, we used tax cuts for companies to stay in America and create American jobs in America. We're providing additional tax incentive for companies to pay their workers prevailing wages, wages you can raise a family on. And if they hire registered apprentices, like those trained and sponsored by unions, that's what happens. For some clean energy projects, they'll still be worth millions of dollars. This is a major incentive to pay prevailing wage and hire union workers. It's good for workers. It's good for the environment. And as companies are beginning to figure out, it's good for companies' bottom line as well. Plus, many auto companies significantly ramped up their investments in electric vehicles. My administration has announced more than $15 billion in funding to help automakers convert existing auto plants while retraining existing workers at good wages, giving them a first crack at the new and different jobs for electric vehicle versus the combustion engine, bolstering the domestic supply chain, and ensuring that auto manufacturing jobs remain good-paying jobs, including union jobs. The auto industry has long been a pathway to the middle class and had provided good-paying jobs. I'm not going to let that change on my watch if I can help it. And if anyone wonders whether unions really make a difference, I urge them to take a look at the new report from the Treasury Department. It's the most comprehensive look ever at the impact unions have on our economy. And it concludes definitively that unions raise workers' incomes, increase home ownership, increase retirement savings, increase access to critical benefits like sick leave and child care, and reduce inequality, all of which strengthen the American economy. Plus, even workers who aren't in unions, even workers who have been laid off, see benefits from unions when they're strong, because unions raise standards across the workforce and industries, pushing up wages and strengthening benefits for everyone. You heard me say many times, Wall Street didn't build America. The middle class built America, and unions built the middle class. Let me close with this. We faced some pretty tough times in recent years. A pandemic that took more than 1 million of our friends and neighbors. 1 million fewer people sitting at our dining room or kitchen tables. People we raised and loved. People we grew up with. Gone. The worst economic crisis since the Great Depression. It wasn't that long ago that 20 million Americans were out of work. But the American people didn't give up. They never give up. They've never given up. And today we have the strongest economy in the world, the lowest inflation rate among the major economies, 13.5 million new jobs. You heard me say it before, and I'm going to keep saying it. My dad said a job's about a lot more than a paycheck. It's about your dignity. It's about respect. It's about being able to look your kid in the eye and say, honey, it's going to be okay, and mean it. That dignity is coming back to places all across the country. While I'm proud of the historic legislation my administration has passed and the policies we've enacted, the real heroes in this story are the American people, average Americans. They're the ones getting up every day, putting their heads down, going out that door and going to work. They're the ones starting new businesses, taking the chances, hiring workers, and fulfilling their dreams. 3 weeks ago, at a clean energy factory in Milwaukee, Wisconsin, I met an IBEW electrician who builds and repairs America's growing fleet of wind turbine engines. He said, and I quote, "In America, with hard work and a little faith, anything is possible. In America, with hard work and a little faith, anything is possible." That's what my father's generation believed. That's what these folks believe too. Every day across this country, ordinary people get up and do extraordinary things. And thanks to them, we're going to continue to grow our economy from the middle out and the bottom up with good paying jobs, more breathing room for families, and American workers building industries of the future. They remind us of who we are. I'm going to keep saying this. We're the United States of America. There is simply nothing beyond our capacity when we set our mind to it and do it together. Have a good Labor Day weekend, and God bless you all.
Why are so many Americans living paycheck to paycheck?
All right, that was President Joe Biden in Washington, D.C., delivering remarks on the August jobs report, saying the U.S. has added 13.5 million jobs since he took office, and speaking about the impact unions have on the U.S. economy. Quick market check here. You're looking at the S&P 500, Dow Jones Industrial Average, both up about 0.1%. NASDAQ 100 down just slightly, 0.1% lower. I want to get straight to our next guest, Eddie Vanderwalt of Bloomberg News. Eddie, we really appreciate your patience sticking with us this afternoon as we just heard from President Biden. I want to get your thoughts on his comments as well as the labor market data this morning in the manufacturing data. Sort of what is your takeaway when he is talking about the resiliency here with the U.S. economy and the job market?
Yeah, absolutely. You know what? I think he probably has a reason to be satisfied with some of those numbers that came out today. The non-farm payrolls obviously came in above expectations and, in fact, above the prior month's revisions. Now, we did see the unemployment rate tick higher to 3.8%, but that's partly a reason, partly because people are coming back to the jobs market. We've got more people participating in the jobs market now. We saw the participation rate pick up. Subsequently to those numbers, we had the PMI numbers come in, which showed that manufacturing in the U.S. actually slowed less than was expected. And that turned the markets around. We're now seeing, the S&P pretty much flat on the day. But I think the real action for me is in the bond market, where we're seeing a real steepening. We're seeing 30-year yields and 10-year yields rise by about 7 or 8 basis points, much more than at the front end of the curve. And what that tells us is that the markets are pricing out a little bit the recession risk. And of course, Biden will be very happy about that coming into an election next year.
I mean, talk to me about the bond market, though. I mean, earlier this week, the 2-year was above 5%. Was that the last we're going to see of that? or do we think that there's a potential here to kind of reverse some of the movements that we've seen over the last couple of days?
Yeah, you know what, the 2 years tried above 5% a couple of times and hasn't liked it. I don't think many in the market think that the Fed is going to raise rates much more. And really the 2-year end of the curve is a bet on whether the Fed is going to be able to hike going into next year, or will be forced into hiking going into next year. And with inflation doing what it is doing at the moment, which is, coming down slow and steadily, not many people think that. The bigger risk, I think, for most economists is that the Fed will have to cut, that they will be forced into cutting because inflation slows, but at the same time, the US goes into a recession. You're seeing the market, Main Street starting to shed jobs. But we're not seeing that at the moment. What we're seeing is that steepening, and we're sitting now with about 70 basis points of inversion between the 2-year and the 10-year points on the yield curve.
I want to get your thoughts on China, world's second largest economy here. I know there's concerns about some of its flagging growth, but is some of the disinflation that's happening, is that actually in favor of the Fed and maybe some other corners of the global markets here as far as when you're looking at these other central banks that are still trying to fight inflation?
I think China has been an exporter of disinflation, right? I think the disinflation that we saw there is feeding through into goods that we buy here and therefore also into services and also into wages. But I think it's wider than that, right? I think it's more worrying because if China is slowing, that's because people across the world is not buying their goods, right? And if we're not buying their goods, that means that we're not spending money, and that's a recessionary flag. Now they've been slowly and steadily, they've been, people were hoping for this kind of big bang stimulus in China. Instead, they've been getting fairly small measures, but somebody in the newsroom said to me earlier today that maybe those small measures are starting to look like a machine gun, right? They're delivering them over and over and over. Every day that you come in, there's a little bit more stimulus. So maybe it's not a maybe it's not a bazooka, maybe it's a machine gun, but the market's starting to pay attention. And we are starting to see, Chinese stocks doing slightly better. They still have a lot of trouble in their property sector, though.
Yeah, I mean, every day you come in, mortgage support here, tax breaks here, stocks support here. I mean, just very quickly, we only have about 20 seconds here, but do you see more of a risk that China contagion than the markets are pricing in? Just yes or no, please.
I think probably yes. I think if China slows down significantly, that's going to be a problem for the rest of the world.
Mm-hmm. Right. Well, world's second largest economy behind the U.S. and, of course, Japan, third largest economy. Eddie, thank you for being patient, sticking with us. We really appreciate it. Eddie Vanderweld of Bloomberg News, of course, breaking down what we were seeing with obviously the jobs picture, and then on the back of those comments from President Joe Biden. Now let's get a check on world and national news with Dan Schwartzman.
Thanks, Jess and Simone. Some states are looking to disqualify former President Trump from appearing on the 2024 presidential ballot. The argument being used by those championing the effort is that Trump should not be eligible due to possibly having violated Section 3 of the Constitution's 14th Amendment. Now, the amendment says that any person who engages or gives aid and comfort to those involved in an insurrection or rebellion against the U.S. is not eligible to assume public office. So far, Michigan, Arizona, and New Hampshire have started to take steps toward possibly removing Trump from ballots, with another 4 states also debating the move. A record 14 million people expected to be flying this Labor Day weekend. That's an increase of 11% from just last year. Today alone, around 2.7 million people expected to be screened by TSA agents. The summer's travel volume has been even higher than pre-pandemic in 2019 and is expected to be the busiest on record. Transportation Secretary Pete Buttigieg on the record number of travelers.
This weekend is capping what TSA reports is the busiest summer travel period on record. The most air travel passengers that have been screened by TSA in American history.
The secretary was speaking from O'Hare Airport in Chicago. A congressional delegation visiting Taiwan says that the U.S. would act if the island nation was attacked by China. U.S. law does require that Washington provide Taiwan with any means necessary to defend itself, but is ambiguous whether that means committing U.S. troops to the fight. Now, President Biden has said on numerous occasions that American troops would help defend Taiwan, although those comments have been walked back. The delegation has also promised to try to resolve the $19 billion backlog of defense purchases from Taiwan that have yet to be delivered. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg. Back to you, Jess and Simone.
Thank you, Dan. We appreciate it, Jess Minton. And Simone Foxman here in the Bloomberg Interactive Broker Studio. And we've talked so much about the jobs picture today, Simone, but we also have other things going on when you are looking at what's happening with Amgen as well as Horizon. So Amgen can move forward with its around close to $28 billion takeover of Horizon Therapeutics after the FTC did say Friday that it accepted a binding settlement that the combined company would not bundle together two of Horizon's blockbuster drugs. I want to bring in Jennifer Rhee, senior litigation analyst at Bloomberg Intelligence. She's always on top of all things when it comes to actually stories and deals like this. Joining us to talk about this FTC settlement on this Amgen Horizon deal here. Jennifer, thanks for joining us this afternoon. Walk us through what this means moving forward with this deal.
Well, thanks for having me. I mean, I think this was a really smart move by the FTC, to be honest. They have sought a way to try to slow down consolidation, particularly in the pharmaceutical industry. And I think that they thought, you know, this is a great opportunity with this merger to try out a novel theory, try to push the law out to make it easier to block pharmaceutical deals, and to try to go to court to get a judge to stop this deal using kind of a novel theory. And what that theory was that those two blockbuster drugs of Horizon that you just mentioned, one for chronic gout and the other for eye thyroid disease, would be in Amgen's hands. Amgen would be able to maintain the monopolies for those drugs because it would bundle it and provide steep rebates for those bundles with other blockbuster drugs that Amgen already has. And it could do that better than Horizon could on its own, and it would block the future entry of other drugs. And here's the thing, that kind of theory could almost be used in almost any pharmaceutical deal. So it was kind of a big deal for the industry. So the fact that it's settling is also a big deal for the industry because it shows that the FTC kind of backed off that theory, which really is a broad theory.
Okay, but I'll dig into the details a little bit for me here. So the Tepeza and Chris Dix, apologies. How does bundling or an agreement not to bundle those drugs accomplish this purpose?
So the idea is that if Amgen provided really steep rebates, let's say to pharmacy benefit managers or insurers, to bundle those drugs, to put it on a drug formulary, what that would do would be to block out other potential up-and-coming new FDA-approved drugs that can compete with those two, with Krystexxa, I can't say it either, any other drug.
It's always a mouthful.
You know, they always are. I don't know why they name drugs the way
they do. They really do.
But the idea is that if there are other innovators out there trying to come up with a drug or get FDA approval for a drug that could treat the same condition and potentially bring prices down across the board for drugs that treat those two conditions, that they really wouldn't be able to get into the market because these bundled rebates would be too enticing for the pharmacy benefit managers they'd have to accept them. And to accept them, they'd have to put the Horizon drugs on the formulary and not these competing drugs. And so the competing drugs can't get into the market. They can't get a foothold. So if Amgen can't bundle them, it opens up that avenue. It takes away that blockade, right? And it allows for the possibility down the road for other rivals to try to come in and compete against those two drugs.
Who do you consider to be the biggest rivals at this point for them?
You know, I think that's the most speculative part of this entire lawsuit. They really couldn't really name any. I mean, now there may be in phase 3 or phase 2, somewhere along the FDA process, some rivals. Other analysts would be better off who know what's going on in the biotech space to speak about that. But here's the thing. It was so speculative because the FTC couldn't really say, hey, X drug or Y drug or ABC company has something coming soon. They couldn't do that. It was really speculative that maybe down the road, maybe there will be something that might compete and might not be able to. So it was a tough theory for the FTC to try to win in court. And that's why I say that it was probably a smart thing for them to do to get this settlement instead.
Yeah, I mean, also, what do you think that this says about the broader FTC task here? You know, we had Black Knight, ICE, dropping the challenge there yesterday.
Right.
As the FTC's realized that it's run up against a wall?
You know, I sort of think it has. I think the FTC got a little bit tired of losing. You know, they lost two big merger challenges that were really well publicized. That was a challenge to Meta trying to buy a small virtual reality company called Within, and then Microsoft trying to buy Activision. You know, these were really well known, kind of sort of spectacularly public court losses. And I think that they pulled back a little bit. They have been very aggressive. I think they do want to continue to be aggressive, but maybe they pull back to think about, look, we can be aggressive, but maybe we need to pick and choose our challenges to deal just with a little bit more discretion, because when we go into court with a really tough theory, particularly if you don't have the evidence and the facts to back that new theory that you're asking a judge to accept, you know, there's a good chance we're headed for a loss, and we need to get a win down the road. So yeah, I think it probably shows that the FTC is going to exercise a little more caution going forward with respect to challenging specific types of deals.
Jennifer Rhee, Senior Litigation Analyst at Bloomberg Intelligence, thank you so much for joining us. Now let's get a quick business flash from Charlie Pellet.
What's going on? We do have the S&P higher, barely up by 1 point. Little change right now. The Dow up 55, up by about 0.2%. NASDAQ in the red, down 24, drop there of 0.2%. Tech giants weighing on stocks. U.S. unemployment growth employment growth, I should say, topped Wall Street forecast in August. That hopeful sign suggests the economy could skirt a recession this year. Data show employers added 187,000 workers last month, the most since May. And moments ago, right here on Bloomberg Radio, President Biden was talking about progress on jobs.
Just this morning, we learned that the economy created 190,000 jobs last month. All told, we've added 13.5 million jobs since I took office.
Reaction to the jobs report from Julia Pollack, chief U.S. economist at ZipRecruiter, who was interviewed right here on Bloomberg Markets.
This is an interesting report because it really shows you very clearly what's happening in certain industries. We saw truck transportation lose more than 36,000 jobs. That's largely results of yellow freight. That business's closure. We also see signs of the Hollywood strike in this report, with more than 16,000 jobs lost in the movie industry.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Stocks trading mix, the Dow higher by 0.1%. S&P fluctuating in the red, down 1 point, little change there. NASDAQ down 0.2%. 10-year yield right now, we've got the 10-year yielding 4.18%, with the 2-year 4.87%. Spot gold down $2 the ounce, drop there of 0.1%. And West Texas Intermediate crude up 1.8%, 85.15 a barrel. Briefly after earnings, Dell surging 22.4%. Broadcom after earnings down 5.1%. Lululemon Athletica higher by 5.2%. And that is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Minton and Simone Foxman here in the Bloomberg Interactive Broker Studio. And Simone, we've gotten through clearly almost 100% of earnings from this past second quarter season here. And, you know, when you look at overall growth here, only the contraction ended up being just under 6%. The preseason estimates were for 9%. If you remove energy, though, actually wasn't quite as bad. And there was slightly some growth there. But tech was a big thing in growth companies as far as when it comes to those cost-cutting efforts, and then also how that affects hiring, particularly in that space. And so we've continued this theme when it comes to the jobs report today, as well as these hiring trends. So I want to bring in specifically to take a look at what's happening in these tech and growth sectors. Martha Heller, CEO and founder of Heller Search Associates. She's going to talk to us about the open tech roles and the outlook for tech hiring right now. It's always great speaking with you, Martha. Paint the picture here when it's coming to the technology space and what hiring really looks like, because Simone and I have discussed so much when it comes to these bigger companies that have been going through these aggressive cost-cutting efforts and sort of what this means when it comes to employees that are trying to get hired.
Sure. Thanks so much. And it's great to be here. You know, part of this is defining what really is a tech company, because every company, insurance, healthcare, retail, banking, everyone needs to hire technologists. And with a particular focus on AI right now, we know that companies are investing hard in AI initiatives. So when Meta and Google lay people off, that's just good news for these other companies, health tech, insure tech, manufacturing tech, all looking to snap up these technologists. So a good technologist, a good developer will find themselves plenty of employment opportunities. A way to think about it is, big tech's trash is Nationwide and Walmart and Walgreens treasure. So any good technologist it has many, many employment opportunities, even if the tech sectors are doing some layoffs right now. Tech sectors layoffs are really, really good news for pretty much every other industry.
That's so interesting. I mean, we've seen, it looks like 4 straight months of tech layoffs, and I'm looking here. Jess always has the function insight, but I'm going to bring up ECAN, ECAN. We can see that in a breakdown of the jobs report. Are we nearing the end of this?
I think we're going to see more leveling off from big tech companies who were very enthusiastic in hiring up all of the wonderful technologists on the market. I think we're still going to see some layoffs coming out of that sector, but I think we're going to see an overcompensation of hiring in other sectors. For example, for a long time, it was only Google who was really interested in data scientists. Now every company wants to hire data scientists. So if Google overhired on data scientists, no worries for that very important small talent market, because everyone's going to be hiring them. So I think we're going to see a growth in technology hiring in general over the next quarter, even if we still see some more layoffs coming out of big tech.
So Martha, as an executive recruiting firm, are you specializing more in senior level technology roles?
We focus on senior level technology roles across all industries, but we also have started recruiting the individual contributors and the entry level folks. So we're gaining that insight as well.
How tough is it right now to get a senior level role in that industry?
It is still a candidate's market. Mm-hmm. So any qualified senior technology leader is in high demand from most Fortune 500 companies, because they're all looking to transform. We used to be a healthcare company. Our future is to be health tech. We used to be an insurance company. Our future is insure tech. So as more companies move into the space occupied previously by pure big tech companies, it is going to continue to be a candidate's market, with the employers working hard to hire good people.
So is it easy for them to find talent?
It is not easy for them to find talent. And one of the reasons is, what is this talent? So for example, data scientists. Data scientists are in very high demand, but it's a very new role. They're very expensive. They're very rare. So, when I talk to CTOs across companies, across industries, which I do all day long, their greatest challenge right now is hiring data scientists, hiring data engineers, and hiring security people.
Talk to me.
Go ahead.
Sorry. Talk to me a little bit about the AI craze that we have been seeing in the stock market, but has that reflected in the salaries that people who are gifted with some of this stuff are able to command?
Absolutely. We are seeing rising compensations in any of those data leadership roles. AI is in particular in high demand, and so we're seeing people costing more in the AI space.
Can you give us a number? Can you give us a number there?
I would say 10 to 15%. We're seeing those compensation figures go up. So not huge. But again, a lot of companies have never even hired these people before. So they're having to come up with these new salary bands for roles that they don't really understand just yet.
Hey, Martha, we only have about 40 seconds left. What are employers telling you about their view of the economy?
It's been wait and see up until now. Most of our clients are telling us that next quarter is when they're going to start dusting off their recs and put an opening position. So we here are gearing up for a very busy September and October. In fact, my biggest challenge is hiring recruiters to meet all the demand that employers have for technology talent.
So whenever people are arguing about a recession coming, do you see that?
Not from my lens. I do not see a recession coming. We have very aggressive growth goals here, which we anticipate exceeding.
All right, Martha Heller, CEO and founder of Heller Search Associates, that recruiting firm that does work with senior level technology leaders. Thank you so much for joining us. Really interesting take there, especially her view on where things are headed with the economy. And Simone, she's not seeing a recession here on the horizon. More optimistic outlook. I like that.
Best of luck to her for sure.
All right, we'll have more coming up. This is Bloomberg. Now let's get a check on company news with Lisa Mateo.
Thank you, Jess. Tesla is handing out another round of price cuts, and it's giving its Model 3 a fresh new look and longer range. More from Bloomberg's Katie Greifeld.
That Model 3 now rated to go 377 miles on a single charge in China. There's also two new colors, stealth gray and ultra red. But probably more consequential to Tesla's bottom line are those steep price cuts to the Model S and to the Model X in both the U.S. and China. Tesla now charging just below $75,000 for the base Model S and just below $80,000 for the Model X.
Now, Tesla shares right now down about 4%. Just as the NFL season gets underway, millions of football fans are learning they won't be able to watch the games because of a contract dispute. Bloomberg's Scott Carr has more.
Nearly 15 million Charter Spectrum cable subscribers have lost access to ESPN, ABC, the Disney Channel, and other Walt Disney-owned networks. More than 24 networks have gone dark on cable systems in several major markets, including New York and L.A.
Shares of Walt Disney right now down nearly 2%. Shares of Charter Communications down nearly 3%. And Taylor Swift is breaking records once again. Screens at AMC. Well, the concert film broke the theater chain's advanced ticket sales record in just 3 hours. It grossed $26 million on Thursday. AMC now adding additional show times. The shares right now down 4%.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Jess Mitten, Simone Foxman here in the Bloomberg Interactive Brokers Studio. Quick check on markets and how they're performing. You're looking at the S&P 500 up about 0.1%. Dow Jones Industrial Average up about 0.2%. NASDAQ 100 virtually unchanged. Looking at the energy sector in the S&P 500 up about 2% on the back of oil prices being up also 2%. U.S. futures trading around $85 a barrel. But first, let's get a check on world and national news with Dan Schwartzman.
Thanks, Jess and Simone. According to a court filing, the architect of the Trump campaign's fake electoral plot, attorney Kenneth Chesebro, has pleaded not guilty in Georgia. Chesebro has also waived his right to an arraignment hearing. The attorney is facing 7 charges, including violating Georgia's RICO Act, along with conspiracy to commit forgery. Chesebro, who denies any wrongdoing, is scheduled to go on trial beginning in late October after he invoked his right to a speedy trial. The deadly toll of the COVID pandemic laid bare systemic issues at the nation's nursing homes. Now the Biden administration is making changes, as we hear from Bloomberg's Nathan Hager in Washington.
The federal government is going to start dictating staffing levels at nursing homes for the first time. Under the proposed rules, homes would need to have staff equivalent to 3 hours per resident per day, with just over a half hour of that coming from registered nurses. Advocates have been calling for regulations of nursing home staffing for decades, but this proposal is far lower than they'd hoped. The average nursing home already has 3.6 hours of staffing per resident per day. In Washington, I'm Nathan Hager, Bloomberg Radio.
Thanks, Nathan. The U.S. Food and Drug Administration says it's finalizing rules that will prohibit the sale of menthol cigarettes along with flavored cigars. The FDA's original plan was to finalize all the details by August 2023. That, of course, has now passed. Menthol is the only flavor that has yet to be banned in cigarettes after the rest were banned back in 2009. Scientists have said that menthol flavoring makes cigarettes more addictive than tobacco-flavored ones, while a 2015 study showed it made people want to smoke more. According to the CDC, more than half of kids who smoke today are using menthol cigarettes. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg. Back to both of you, Jess and Simone.
Thanks, Dan. We appreciate it. We hope you have a nice holiday weekend there. Bloomberg Markets is now on YouTube. Watch us every weekday starting at 10 a.m. on your TV, computer, or smartphone. Just visit youtube.com and search Bloomberg Global Markets. Jess Mitten and Simone Foxman here in the Bloomberg Interactive Broker Studio for the final 3 minutes here ahead of Sound On. Of course, Matt Miller, Paul Sweeney have the day off, but I hear they will be back next week. But Simone, I know you're looking at a story here on the terminal ahead of these last few minutes here with us. What are you looking at?
Yeah, Jess, you know that I'm fascinated by these GLP-1 receptor agonist drugs. These are the Mounjaro, the Wegovy drugs, initially prescribed for diabetes, but they found that they cause people to lose a dramatic amount of weight. Well, apparently they also may encourage people to cut back on alcohol. So
really?
A survey conducted by Morgan Stanley's AlphaWise research unit, they found that people consumed 62% less alcohol while taking weight loss drugs. And among those consuming less, a full 22% said they stopped drinking entirely. So I think what some of our Bloomberg opinion columnists point out today, Lisa Jarvis and Leticia Miranda, is that potentially the rise of these weight loss drugs could prove a huge headwind for spirits companies, for beer companies, etc.
You know, before you came in, John Tucker and I were doing a count on every time people were saying Goldilocks, and as far as like, would you take a shot or not for that? It got up to, I think, eight there. There was somebody we tried to get say it, but unfortunately they went around it and didn't say it.
So you guys were pretty toasted, maybe. No, I'm just kidding.
But I mean, obviously, going into the Labor Day weekend, though. But this is really interesting, just seeing the dynamic here. And a lot of the stock moves we've seen in coordinates as far as some of the news that we've gotten out of some of these weight loss drugs. But always great stuff, Simone, getting your perspective on all things this. And always a pleasure being able to co-host with you as well.
Oh, thanks. It's a pleasure being able to co-host with you, too, ahead of the Labor Day weekend.
All right, we do hear Matt Miller, Paul Sweeney. We should be back next week, so stay tuned for that. But always a pleasure here. But Jess Mitten and Simone Foxman, Sound On with Joe Matthew starts right now.
From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, a pickup in unemployment gives a gift to bond bulls, only to see yields reverse after strong ISM manufacturing figures, with Wall Street saying the Fed can pause from here. We begin with the big issue, the Fed's Goldilocks moment.
The kind of Goldilocks scenario that the Fed wants.
The Goldilocks number.
Labor markets are normalizing. Federal Reserve, it's a pretty good report. I mean,
that's great news.
A little bit less wage pressure, which is good from the Fed's perspective.
Wages coming down is significant.
Softening in wage gains.
That stubbornly low unemployment rate finally ticking up.
Greater labor force participation.
Working in the direction that the Fed wanted to go.
Everything is looking like it's moving in the right directions.
The Fed is going to say this is clearly a labor market that is rebalancing.
The labor market can be a real slippery slope.
The Fed's looking so carefully at the data.
Is this the data point that Fed needs?
It's about restrictive policy for longer, not higher for longer.
Read what the underlying trend is in data.
Follow the labor market. The Fed that is likely to press the pause button on the rate hiking cycle.
I think the Fed should be done.
Joining us now, Marianne Bartels of Sanctuary Wealth and Columbia Threadneedle's Ed Al-Husseini. And Ed, since you're sitting next to me on set, I'll give you the first question. Let's talk about the price action this morning. We got the jobs report, unemployment rate finally coming up. 2-year Treasury yield goes 10 basis points lower. We got that ISM manufacturing figure. Now we're 3 basis points higher. Talk us through that round trip, and what's the right read from the numbers we got today?
Well, first, it's the last Friday in August, so let's be careful. Not a ton of liquidity. But the fundamental issue here is the market trying to find an equilibrium around where the Fed is going to be next year. I think the question around this year, really, we're micromanaging this probability of an additional hike. In my mind, yes, there's a pretty good reason to hike one more time. That's decently getting priced in. The question is how much space there is for easing next year. And the data in aggregate right now doesn't give the Fed a lot of room relative to market pricing. We're seeing that market pricing get taken out.
Marianne, let's come to you on that issue. When you think about what the market is priced for and what we're hearing from the Fed, how much distance do you think there is between those two?
Well, I think everyone is trying to figure out where the Fed is, and we've been trying to figure that out all year, and we've had a hard time. The market has had a hard time figuring it out. I still think that there's a distance. I do think that there's a camp that can argue that the Fed should pause and stay on hold, and there is a camp that they may have to raise rates. Don't forget that we're recently in the middle of wage negotiations with significant higher wages. So although we saw a tick down in wages, does that mean the data going forward, if we're getting higher wages in other pockets of the economy, does that mean it's actually really, bottomed? So I'm still suspect. And I think rates are moving today. Yes, the data is mixed, but rates from a technical perspective are extremely oversold. And I think that can argue that they can rally. They're holding key technical levels. And I'm still in the camp that we have not peaked in rates. I still think that there is a risk at some point, whether it's later this year or next year, that the Fed may have to raise one more time.
Marianne, I'm so happy you brought up the strikes, and let's talk a little bit more about that because it was interesting. Within this data from the BLS, we learned that the film industry, in terms of payrolls there, fell by 17,000. You look at trucking payrolls, fell 37,000. How noisy is the data that we got today, and how noisy could it get when we think about the impact of these strikes and those wage negotiations?
Well, that's why you want to use moving averages whenever you're looking at any data, because any data point is not a direction. You want to smooth things out to really get a trend. And I don't think in most of the data that we have a very clear picture, which is why the market is having a hard time trying to actually find where the Fed is. And don't forget, Powell was very clear, and I think this was a very important. Last Jackson Hole last year, he opened up that he was going to keep at it. This Jackson Hole, he closed that the Fed will keep at it. I think that was a very strong signal that they're data dependent and they're not afraid to continue to raise rates if they need to.
And Ed, you heard Marianne bring up the point that rates look oversold here, and there's a really interesting debate about duration going on. We actually heard from Ian Lingen of BMO and BlackRock's Jeff Rosenberg on that debate. Let's take a listen.
The 10-year Treasury, in my mind, is a screaming buy. I think that we do get 10-year yields back to 3%. I don't think it happens this year. I think that that will be a first half of 2024 event.
I think that the screaming buy is the 2-year. Thank you for bringing it up. Because I think there you have the best combination of yield and the exposure, as we're seeing in today's market reaction to changes in this kind of normalization. That is the part of the yield curve where I think you're going to have the best risk reward in terms of owning duration.
All right, Ed, we've got the Ian Lingen view. We've got the Jeff Rosenberg view. Where's the screaming buy in Ed Al-Husseini's minds?
Oh, man. I'm very tempted to split the difference and say the intermediate part of the curve is pretty good. And I really think, look, the intermediate part of the curve, both in terms of real rate valuation, is quite attractive. It gets you a little bit away from some of the debate that we're having at the very front end of the curve in terms of, look, how much hiking is there left to do? How much easing will the Fed have room to do next year? The intermediate part of the curve, I think, does offer some value. The curve is inverted. We think that the curve will steepen out, and that really benefits that intermediate part most aggressively. But I have to say, most of the screaming this year has come from bond investors. And so clearly the curve hasn't found an equilibrium yet.
Let's talk a little bit more about the intermediate part of the curve. Can we call it the belly? Is it safe to call it the belly?
Let's call it the belly.
All right, let's talk about the belly and the love for the belly. What's going to drive it there? Is that a bet on basically rate cuts in the next 5 years or so?
Think about it this way. There's sort of 3 pathways to a steeper curve that would benefit that intermediate to front part of the curve. One is a recession. Of course, the Fed will be under a lot of pressure to cut rates in that environment. 2 is inflation coming down, and that's really been the story of this year. The key story has been inflation has come down much faster than the Fed anticipated, and I think than market participants anticipated. The third part of the story is a steeper curve led by long ends moving higher. And that really damages the 10 and 30-year part of the curve. That's the economy repricing to a higher neutral. That's the economy repricing to an environment where we can sustain higher rates and yet generate growth, which again has been the story of this year. So I think the intermediate part of the curve kind of captures the best risk reward between those 3 scenarios.
And Marianne, come in on that. You did make the point, again, that rates look oversold here. When you look across the curve, though, where do you see the most dislocation? Where do you see the most opportunity?
So I would agree with the 2 speakers. We're doing more of a barbell. We like the front end and we like the back end, and we don't like the belly. So we would balance between the short end and the long end. But I'll tell you something that keeps me concerned about fixed income. When we look at sentiment surveys and how fund managers are saying that they're positioned in fixed income, especially relative to equities, we have an overweight in fixed income and an underweight in equities. And my experience has been when you deal with sentiment of that kind of extreme, it has to flip-flop. So the risk is that something negative happens in fixed income and something positive happens on the equity side. So I still think we're going to have a lot of volatility in fixed income. If you look at the move, ICE, BofA volatility index for fixed income, it remains elevated and much more elevated than the volatility than we're actually seeing in the equity market. And let's also not forget the banks and the unrealized losses that they have. And if rates continue to go up, that's going to be problematic. And something that we watch are called relative ratios. So we'll take a stock price and look at it relative to the S&P. Citibank, a money center bank, just recently traded at an all-time relative new low, below where it was in 2008 and 2009. That is just shocking. So I think the banks are going to play a very key and pivotal role in where we're going in the fixed income markets eventually.
Well, Ed, on the topic of the banks, you think about some of those small and mid-sized lenders. One of the big problems there is they're going to have to pay up for deposits. And you take a look at money market funds, I believe hitting a fresh record in the week just past, nearly $5.6 trillion in money market funds. If we continue to see that flow of cash, and it remains to be seen whether that's coming out of deposits or simply a safe haven trade, what's the pressure on the banks?
Well, in my mind, the key pressure right now is their capacity to raise additional capital. So we're seeing issuance go up. I think the good news is we have a lot of capacity to absorb that issuance in investment-grade capital markets. So banks are going to very likely shrink their loan books, raise additional capital, and be quite conservative going into 2024. And in some ways, from a financial stability perspective, that's exactly the mode that we want them in. One of the surprises, obviously, this year has been the economy in some ways has accelerated, despite the fact that lending conditions have tightened at the bank level. That tells me that some of the bank lending is being intermediated away from them, private credit, et cetera, et cetera. And so the longer-term story for them is how do we maintain a business model where we're being eaten away from very aggressive competitors.
A good note to end on, a really tricky existential moment for these banks. Marianne Bartels and Ed Al-Husseini, thank you both so much. Really enjoyed this conversation. Up next, it's the auction block. LVMH helps European issuance close out August in style. That's coming up next. This is Real Yield on Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where it was completely dead over here in the U.S. this week. Meanwhile, there was plenty of action, though, in Europe, where we saw around 35 billion euros of sales, highlighted by names like Volkswagen, LVMH, and Caterpillar. The region had the second highest August sales level in 10 years. Looking ahead to sales for September in the U.S., banks that underwrite the bonds expect about $120 billion to be issued, much more than the $78 $2.8 billion sold last September. And checking out the month's forecast for high yield and leveraged loans, we should see a pickup of more than $15 billion. That is much more compared to pandemic years, but falls way short compared to 2019, which had a roughly $60 billion pipeline. Speaking of high yield, Michael Contopoulos of Richard Bernstein has his doubts.
Corporate credit just looks way too rich. I just don't see the benefit of owning, whether it's high yield or investment grade corporate credit here. Spreads are so tight, you're not compensated for any sort of uncertainty. And as rates continue to go higher and companies need to refinance, obviously that's happening all the time in the loan market as rates float. But in the high yield market, as basically, companies come to market and issue new debt with much higher interest costs, unless their earnings are accelerating to a much higher degree than rates are going up, there's going to be a lot of pain in high yield.
Joining us now, I'm thrilled to say we have Schwab's Colin Martin and Tom Tezoris of Strategas, a Baird company, joining me both on set on a summer Friday, which is a particular treat. Let's start with you, Colin, on that point that Mike Contopoulos made. When you look at spreads right now, I'm looking at 120 on investment grade, about 370 on junk bond spreads. Is that too rich against this economic backdrop?
It is too rich, and I share a lot of the same concerns, although we are more positive on investment grade. But with high yield, coming into the year, there were a handful of indicators we were looking at that are still ringing true today that suggest spreads should be a lot higher, and it just hasn't happened. And if you look at the performances here, it shouldn't be too surprising. I mean, stocks are up so much, and they're both risk assets. Also, you have the whole soft landing idea. But if you have an inverted yield curve, you have banks tightening credit standards, and then if you have spreads so low, as you mentioned, 3.7%, we just don't think it makes too much sense. Given how high yields are across the country, across the globe, why take so much risk when you can get 4, 5, 5.5% with investment grade rated issuers?
Or with cash, I'm not sure. Tom, come in on that point, though, because Colin mentioned performance. I like to look at ETFs in particular. And if you look at popular tickers like J&K and HYG, they're sitting on total returns of 7%, 6%. They've seen enormous outflows all year. And really, as a category, you've just seen high-yield bond ETFs just shed billions of dollars. Why aren't flows following performance? Is this a valuation story?
Well, I think very much like you saw in the equity markets over the last 2 decades, you saw the depublicization of the equity market. You're seeing public credit markets also generally shrinking relative to the private credit markets. So, yes, you're seeing outflows from the broadly traded public credit market indicators like high-yield ETFs, but credit liquidity is flowing in from, it was mentioned by an earlier guest, private credit, direct lenders, and that is helping to kind of stem some of the stress that's building. But the big picture, I would echo Colin's comments here, that simply put, we're too tight on the IG side, even if there's no recession, by maybe 10 to 20 basis points, and if there's a recession, probably 80 to 100 basis points. And on the high yield side, we're even more egregiously mispriced, in my opinion. Even if there's no recession, we're probably 100 to 150 basis points too tight on the high yield side.
I want to get to private credit, but you brought up some specific levels. Colin, I'm curious if you have any levels in mind that would be closer to fair value.
Yeah, I think a lot higher than they are now. If we look at historical, or even just over the past 10 or 15 years, how high have spreads gotten in periods of slower economic growth or just general market volatility? You tend to see spreads in the 7 or 8% range, and we're only at 3.7. Doesn't mean we'll necessarily get there now. I think the market dynamics have changed a bit. You mentioned private, so I won't get into that. The size of the market has shrunk. There's a lot of things out there. So we think it's probably a lot higher than it is right now, and we wouldn't be surprised if high yield got to 5.5 or 6% in the next 6 or 12 months.
Feels a long way away right now, but let's talk a little bit more about private credit because, Tom, it feels like it's eating everything.
Yep. And right now, no one really knows how large this market is. Even the amount of assets that are under management, dry powder, there's a lot of ambiguity there. What we can say is it's large. It is probably rivaling in size the high yield market itself and potentially rivaling in size the high yield market plus the bank loan space, depending on how much there is in the pipeline coming from, we'll call it pension funds that could come in and actually continue to increase allocations. So we're talking, reasonably speaking, somewhere around $2 trillion in size, with something on the order of $400 billion to $500 billion of dry powder. That appears to be the case right now. Now, that's not going to keep spreads from widening if there's a recession in the high yield space, but that is certainly adequate to keep spreads anchored where they are right now while stress is not apparent.
Colin, should I be scared?
Should you be scared? I don't think so for now. Things are looking okay. If we look at defaults, for example, and this is something that we've been paying attention to, defaults have been picking up, and they're probably picking up in the private markets. We just don't know because we can't really see the data. But in the public markets, they are, but they're not surging higher. It's kind of a gradual increase, kind of just back to long-term averages. We think as time passes, though, it's the higher for longer and just the impact of these higher rates. What does that mean on these companies' bottom lines? If you look at loans and a lot of companies that private credit is lending to, with floating rate coupons, they've seen their interest expense, their annual interest expense, more than double over the past 12 months. How can you sustain that for the next 12 months in an environment when corporate profits are slowing? So we do think that's a big risk right now.
What does this mean for bank business models? I mean, we were just discussing in the last segment the really absorption of funds going into money market funds, maybe coming from bank deposits, and then you have private credit also booming, just to make matters a little bit trickier. Tom, what does this mean for both the sector and the debt?
Well, I think what this means is for the banks that their business model continues to be one that's going to be under pressure from regulatory attack, and it means that there's going to be more of an emphasis on, we'll say, fee-based income, fines for penalties for their clients, things like that, as opposed to a lending pipeline. And what lending pipeline is going to be in existence 2, 3, 5 years from now is going to very much be a lend to securitize type of model. And that means it's going to favor the larger lenders. Scale, size is going to be, we've heard this story before over the last decade. I don't think that changes. So it means that the regional banks are going to continue to be under regulatory pressure and competitive pressure from all different angles. I think that's the case we're looking at, and I don't think that's particularly surprising given what we've seen so far.
I mean, we could keep this conversation going for an hour probably, but I only have 2 minutes left with you guys, so I want to talk a little bit more about levels before I let you go. There was an interesting quote from Cameron Dawson on television, I think it was yesterday, talking about basically if we saw 10-year yields go back to 3%, and there have been some calls for that, that would be a screaming sell for credit, which I thought was interesting. And I'm curious, Colin, what would be more painful for the corporate credit market at this juncture? Would it be 10-year yields going to 3% or to 5%?
That's a good way of framing it. I'd say to 5%, because then you have that all-in cost in an environment that we still think is slowing. If the economy does slow and inflation remains sticky, that's a problem for corporations. And on the flip side, though, not to kind of play both sides, if we go down to 3% on the 10-year Treasury, that's not happening for good reasons. The Fed would be cutting in that instance, and again, not for good reasons. So both would be relatively bad, but our main theme and what we're telling all our clients at Schwab is to focus on quality. Regardless of either outcome, it's those junky companies that are most at risk right now.
And Tom, we have about 30 seconds. What's scarier, 3% or 5%?
I would agree 5%, but what you've just highlighted is really that when you are an investor, let's say in a CCC credit, you're short yield volatility. That is, if you get big jumps or big drops in, say, the 10-year yield or the 5-year yield, you are going to see spreads widen out for multiple reasons, and that exactly illustrates just that problem. But I'd say 5% is the place I would really be worried about.
Well, this Treasury market has been defined by volatility, so sounds like pretty fun dynamic. Guys, we got to leave it there. Really enjoyed this. My thanks to Colin Martin and Tom Tezoris. Still ahead, it's the final spread. The week ahead, Fed speak picking up again. This is Real Yield on Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up. Markets close on Monday for Labor Day. Then durable goods and factory orders coming on Tuesday ahead of the Fed's beige book out on Wednesday. And then we have Fed speak picking up midweek with Collins, Harker, Bostic, Logan, and then we get another round of jobless claims. But it's probably that parade of Fed speak that you'll probably want to keep your eye on from these people. Of course, we've had so much economic data this week. Wall Street really divided on what this means for the Fed, both how much higher and for how long we stay at those high levels. But that's a question for next week, because from New York, that does it for us. Same time, same place next week. This is Bloomberg Real Yield, and this is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
I'm John Ehrlichman. Welcome to Bloomberg Markets.
I'm Bonnie Quinn. Let's get a quick check now on those markets after the jobs report. The S&P 500 really isn't going anywhere right now, but that belies what's been taking place the last few hours. We've had a lot of churn. The NASDAQ 100 down about 0.25%. There's a bit of a bifurcation in the chip story today. We'll dig into that today as well. Crude oil firmly above $85 a barrel. That's pretty significant. And as you can imagine, the dollar is bid once again today. Let's look at the rate-sensitive 2-year U.S. yield. We saw a bit of a round trip today. It, as you can see, plunged after the jobs report. And then it was reversing that decline right before the ISM manufacturing data, which showed strength, particularly in prices paid and also in employment, and so that had an impact. And as you can see, if you hadn't known anything, we're exactly where we were this time yesterday. And let's get a quick check now on where markets are pricing in Fed policy. It looks like we are very, very, very close to the terminal rate. We may even be there. We're just a couple of basis points away from what the market is pricing in right now is the terminal rate, John.
Well, that's helpful context, Vonnie, and let's stay on the theme of central bank strategy, because obviously higher interest rates have been cooling not just the U.S. economy, but the Canadian economy. Today, we got GDP for the second quarter, and it showed a contraction. And in the economist community, there's actually an expectation we'd see a gain. So to walk through the numbers on an annualized basis, we saw GDP decline 0.2%. The economists who track the Canadian economy expected something well north of 1%. Even the Bank of Canada itself hadn't been anticipating stronger growth. We do have a Bank of Canada interest rate decision, Vonnie, next week. Most economists are not expecting any move on interest rates at this point, and households that are dealing with higher debt loads are increasingly feeling squeezed, and we did see that in the overall spending trends, given all those interest rate hikes, which have left them, at least in Canada, at more than a 2-decade high.
Such a fascinating global economy right now, John. Well, as traders and economists digest data from both the United States and Canada, PIMCO's Tiffany Wilding sees pain ahead.
There's a lot of headwinds to the economy overall in the back half of this year. Obviously there's been a lot of discussion around student loan prepayment starts, but in addition to that, just the fact that we've seen tighter credit conditions, that also impacts the economy with a lag. Loan growth this year has been pretty stagnant. And so you are going to start to see those effects. We think they will become more clear in the back half of this year. And in that kind of environment, it's not necessarily clear that the Fed needs to hike again.
In light of those comments around headwinds, let's get some more perspective. Bloomberg economist Stuart Paul joining us for his take on both the jobs and manufacturing data today. I mean, let's start with the jobs report, Stu, because at the end of the day, the headline numbers showed more jobs created than expected on Wall Street. But when you look at the actual strength of the jobs market, what do you see right now?
The headline number totally overstates the strength of the job market. I think you totally need to read through the 187,000 jobs added. We need to keep in mind that every single month this year, the number of jobs added has been revised down. The June figure, when it first came out, showed 209,000 jobs added, revised down in July, revised down again today to show 105,000 jobs added during the month. With additional workers entering the labor force, primarily older men and prime working age women, folks who perhaps might have been able to rely on strong household balance sheets, cumulative excess savings that they've been able to run down. As they enter the labor force and drive up the unemployment rate, it's pretty clear that the labor market is loosening. Again, also evident in the declining number of job openings that we saw earlier this week.
How do we read the ISM data? Because we did see strength in things like employment and prices paid, which are the two things that you might think might be red flags a little bit, but we're still in contraction territory.
We're still in contraction territory, and what's clear when you read some of the comments that come from the respondents to the survey is that there's a little bit of a standoff between producers and consumers about who's going to run down their inventories first. Consumers are trying to hold their inventories steady, if not run them down, so that they don't have to pass along any any sort of additional price cuts down the line, down the supply chain, and producers are doing the same thing. They don't want to end up with bloated shelves or excess stock on their shelves when they see demand falling off in the second half, deeper into the second half of the year, based on factors that Tiffany was just describing in the previous segment.
Stuart Ball, thank you so much for all that context.
Thank you.
Much appreciated. Let's now bring in Nir Kesar, Unison Advisors founder and Bloomberg opinion columnist. So Nir, we're about to head into the fourth quarter. We do have a full month more before we hit Q4, but essentially September sort of begins that process. What do stocks do for the rest of the year? We've had a lot of data now since Jackson Hole.
Hi, Bonnie. I mean, I think the best read of the market is that we are on a wait and see. And this jobs report plays into that because, you know, I think the reason we're talking about jobs to begin with is because we're fighting inflation, and ultimately the labor market is the limiting factor to what the Fed can do. And so you look at the report today and you say, well, this is good news because ultimately this gives the Fed more room to do what it wants if it feels that, in other words, whatever it has done so far, it has not affected the labor market much. And so if it feels that it needs to stop, then fine. If it feels that it needs to go further, that's fine too. But I think ultimately we're waiting for a destination, and it's not clear yet what that destination is, although it is getting clear, no question. And I think until that happens, I would be very surprised if you see a lot of movement from stocks.
Nir, when it comes to valuations of stocks in an environment where we're talking about a cool down, what would be your analysis on how you measure whether stocks are pricey or not at this stage of the game?
Well, I think you have to look at a couple of things. One is, first of all, I think you have to separate what's done great this year, which is, you know, let's call it the Magnificent Seven, basically big tech. Which has had a huge rally, has given back some of that. But the valuations there, depending on where you're looking on, the high 20s or low 30s, and that's, I think, rich by any standard. But the U.S. market in general is not very cheap. I mean, there are certain segments of small cap value that are bona fide cheap, 10 times, 11 times, 12 times earnings. But in general, if you look at, say, for example, just the value space in the U.S. market, which you generally would consider, cheaper than the broad market, it's still trading in the upper teens, low 20s, which, in historical terms is pretty expensive. So, on general principles, you would say, in a moment of uncertainty, depending on where things go with inflation and with the larger economy, you would expect to see some valuation contraction. But there's also the issue of these creeping interest rates, which I don't think, as I've said many times, I don't think you can draw a straight line between the interest rate and the valuation necessarily. But I do think a lot of people think of the interest rate as the opportunity cost of the earnings yield. So if you flip those valuations on their head, in some cases, those valuations are well below what you can just get from T-bills, which is north of 5% now. And that's going to be a headwind, I think, for valuations also.
It's a good point. And Nir, I guess if we're in an environment, because we were alluding to the fact that in Canada, there's an expectation, for example, that given some of the contraction we've seen for the actual economy, that the Bank of Canada is going to be sitting on the sidelines at their next meeting, that we have to get used to higher rates for longer. That environment could potentially change where investors put their money. You alluded to the fixed income market. Obviously, you have a turbocharged AI boom, which is going to keep some investors interested in technology stocks. But if it's a new interest rate regime, even if we're near the end of rates and people are trying to analyze that, how does that impact sector strategy going forward, in your opinion?
Well, it's so difficult. I'm working on some research now about whether, one of the things we always hear is ultimately higher interest rates are going to be harder on growth stocks and value stocks, let's just say. And that plays into your sector question because, growth is predominantly tech and value is predominantly energy and banks, let's just say. You have some sectors that straddle both sides. But, if we can rely on the idea that we're talking about discounted earnings, and that's the way that stocks are priced, then you would have to say that higher interest rates would be bad for growth and good for value. But, I'm looking at the numbers now, and I'll publish them soon in Bloomberg Opinion. And what I'm finding is that it's very difficult. Historically, it has been very difficult to rely on that theory in practice. And so what I would say is that, ultimately higher interest rates are harder on business in general, because when the cost of capital goes up, that makes the business environment harder. It makes it harder to borrow. It makes it harder to leverage. All those things are difficult. Whether they impact sectors in particular, I'm not sure that we can say that with any confidence. I think investors would be better off looking at the strength of the balance sheet, the quality of the company, and making assessments on individual companies versus individual sectors.
But Nir, what are we overlooking? Because I remember this time last year, even speaking with you, we were looking at higher interest rates. We were looking at potentially too expensive indices, right? For the most part, unless you were looking at the Russell or smaller caps and so on. And yet here we are a year later, we've had this massive rally, and the AI story just blew everybody away and continues to. Are we going to miss something if we don't think laterally here?
Well, I think the surprise this year is instructive, Vani, in the sense that I think what it tells you is that it's very difficult to know in the short term what macroeconomic signals are going to affect what stocks. So from that perspective, I would hope that people are humbled by the experience we've had this year. Having said that, I do think that investors are making a mistake if they don't look beyond our borders, because what's interesting to me about this moment is you have, to the extent that you want, and I think a lot of investors in an environment like this are looking for quality. You hear people talk about quality all the time. And I think people instinctively run to the U.S. when they think about quality, and rightfully so, because the big U.S. companies are high quality companies, hugely profitable, good balance sheets, all of that is true. However, there are quality companies all over the world. And what I would say is if you look at quality companies, in particular in emerging markets, and you can look at various quality indexes in emerging markets, either on the web or on the terminal if you wanted to, what you would see is that they're trading at valuations that are somewhere a third to a half of what you are paying in the U.S. and other developed markets. To me, that is the one thing, if I had to pick one thing, that's the one place I think investors are missing the most.
All right, Nir, thank you so much for that. That's Nir Kesar, Union Advisors founder and, of course, Bloomberg Opinion columnist. Coming up, Dell soars to a record as earnings point towards a recovery in PC demand. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We've all been there. You get invited to go to Kyrgyzstan, where you're turned into a YouTube kids show star. Build a satellite and play a game with a goat. The point is, Hello World is back, and you should watch it. Thursdays on Bloomberg Originals and Bloomberg TV.
This is Bloomberg Markets. I'm John Olipin with Vonnie Quinn. Time now for our stock of the hour. Dell shares hitting a record higher today, as much as 25%. The PC maker's message to the market quite different than what we recently heard from its rival HP. And then beyond computers, analysts like what they heard about the artificial intelligence boost Dell is seeing, Vonnie, within its server business right now.
Exactly. A pretty phenomenal move, I have to say, today, John. Well, Bloomberg's Brody Ford is reporting on this and is going to explain it all to us. Brody, what was so different to what HP said earlier in the week? Dell seems to be saying the exact opposite.
Yeah, so it's been about a year now of this PC apocalypse. You know, in the pandemic, we all worked from home, school went remote, everybody bought computers, and they said, I'm not buying another one for 2 years, you know? And so over the last year, pretty much the computer makers have had a really rough patch saying nobody's buying things. And so today what we're seeing is one of the biggest examples of better than feared we've ever seen, because, you know, sales were down 13% in the quarter, but that was great news, you know, because we thought it was gonna be a negative 20% drop in sales. So what this really means today is that things are looking up a little bit. And why did Dell do better than HP? They have a bigger mix of the corporate customers. And there's also just some differences in their exact markets, right? I mean, maybe Dell has better pricing power. The exact reason they diverged is kind of interesting and not fully understood at this point, but it was different, and that's why we see the stock pop.
Yeah.
Well, Brody, speaking of not necessarily understood, we have talked endlessly about AI this year, and we know the usual suspects that we cover that story through. Can you connect the dots on how Dell is capitalizing on the AI boom?
Yeah, you make a great point that everybody wants to tell an AI story, even companies that you might not think of. And so what Dell here, their argument is that they make servers, and you know, no matter how much we hear about the cloud, plenty of companies still need physical servers to run things like large generative AI models. And so their argument is that, look, we will sell you these servers that are chock full of these great NVIDIA chips, and it's going to allow you to run these AI workflows. What we saw in the quarter is they said they had $2 billion in contracted sales they hadn't yet seen as revenue. So it's not actually lifting the top line yet. It's more of a point of long-term investor excitement about it. So I would say that's for sure part of the increase we're seeing today.
All right, so the AI excitement, a possible PC trough, the 1-2 punch on this Friday for Dell.
Exactly.
Brody, thanks a lot. Bloomberg's Brody Ford breaking it down for us. We'll continue to track the Dell stock story today. Coming up, the SEC delaying decisions on a number of Bitcoin ETF filings, and we'll find out what that ultimately means in terms of the crypto market performance. Right now, Bitcoin shares have been losing momentum over the last few days. We'll check in next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back
lack a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I think the initial reaction, the initial headlines were Grayscale achieves a victory in court versus the SEC. But once people had actually read the ruling and what it meant, and that what it meant was we are closer to having a spot physically backed Bitcoin ETF, but that day hasn't actually happened yet. And as people have digested that, then some of that enthusiasm, over-exuberance, if you like, there was a bit of a reality check, and there are still a number of hurdles, a number of milestones that need to be crossed before a physically backed spot Bitcoin ETF will be listed in the USA.
This is Bloomberg Markets. I'm John Altman with Vonnie Quinn. Some of Bloomberg's conversation with CF Benchmark's CEO Sui Chung yesterday. Let's discuss more on the big Bitcoin ETF developments with CoinRoach CEO Dave Weisberger. Dave, nice to have you back with us. And I guess within your shop, what kind of water cooler talk has there been? How big a moment from your perspective has this been?
Well, in the long run, it's going to prove to be an incredibly important, I call it a watershed event, because you had two things going on here. First, you have the nature of the decision itself, which essentially puts to bed any argument about manipulation in markets being different in futures and spot. I mean, it was always silly to those of us in the industry. I've been saying this for a long time. But when you have a diverse panel of judges, literally in significant age range difference from each political party, et cetera, all basically saying the SEC was arbitrary and capricious in this ruling, it is a very big deal. It basically will be used by people throughout the financial industry to say, listen, the SEC, what they say can be challenged. I think that matters. But the water cooler is really funny because basically we've seen this twice now. I mean, I'm going to do a piece later. I'm going to call it The Boy Who Cried Wolf. The fact is, as your previous speaker mentioned, people are looking to buy Bitcoin from the average walks of life, people who have a registered investment advisor, a financial advisor, and a 40 Act fund and all of that. And that requires ETFs actually being approved. This is news that makes it more likely that future news will happen. And considering what's going on in the summer, considering the doldrums in the market, basically now, not once but twice, speculators that pump the market up on this sort of news for future news have been burned. And the market is back down to where it started and kind of back in the summer doldrums.
I was going to ask you about that because that has come up repeatedly, that a lot of people see huge positive developments here. And yet if we look at even Bitcoin prices today, obviously trailing off as they have for the last couple of sessions. Maybe just walk us through again how you feel the market has been reacting to this.
Well, look, we've been stuck in a trading range for quite some time. The market made tradable lows when FTX collapsed, almost a year ago now, 9 months ago. And those tradable lows were people who were forced to sell Bitcoin, pushed the price down into the 15s. There were strong natural buying demand that rallied it back up into the mid-25s. Since that point, we've had several attempts at breakouts. Most of those were, the first one, big one was on BlackRock first filing, and then this one yesterday. But basically what you have is speculators who are buying and selling on the margin. The important stat to keep in mind is 75% of all Bitcoin haven't moved for a very long time, for a year. So long-term holder percentages, owners of Bitcoin, are way up and has been steadily increasing for a while. So you have certain people who are, I will actually label them smart money in this case, who are long-term buying on the basis of, effectively potentially very large outsized returns relative to risk. in the long run. And in the short run, those same people are patient. They don't chase prices. So when these whooshes happen, the only thing that's going to make those long-term holders who are patiently accumulating participate is quite frankly, it not coming back down. And they're going to need confirmation of that. And so, in Bitcoin, a lot of people say price action begets price action. But the truth is you have an alignment here of fundamentals and price action. And the supply-demand dynamic hasn't changed yet.
Dave, at the moment, courts are a little bit more favorable than some of the agencies to business interests, and we're seeing that again here. But at the end of the day, the SEC will have some power. Is there a need for 30 of these products from various shops? And if so, why 30?
No, but look how many gold ETFs there are, or silver ETFs, or ETFs on large cap tech stocks, or whatever. I mean, I got started in ETFs a long time ago. Actually, was on one of the first patents for an early ETF product back in the early 90s. So I laugh. The ETF industry as a whole provides immense value. But obviously, the first 2 or 3, 4 biggest ones are going to end up with the lion's share of the assets. Eventually, you'll have ETFs that have digital assets as a component, or Bitcoin as a component of ETFs, not just a Bitcoin ETF. There will be Bitcoin ETFs, but I don't think there will be 30 of them. I mean, we'll see which ones win and which ones lose, but I agree with you, basically.
Dave, thanks very much for the time. Appreciate the reaction. Dave Weisberger of CoinRoost joining us as we continue to track what's happening in the crypto market, Vonnie, but also what's happening in the broader markets. We've started a new month of trading here. A bit of a quiet day overall. Certainly, we've been digesting the economic stories, the jobs report, coupled with the manufacturing story that, in the end, has left investors largely on the sidelines, leaning into, say, financials and energy a little bit more than tech, which as a group has been a bit softer for the session overall. Obviously, we're continuing to track where the Fed strategy goes from here after that economic report. And I should add that in Canada, we've got a Bank of Canada interest rate decision heading into next week. For Vonnie Quinn, I'm John Ehrlichman. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Jobs data show a smooth downshift in the labour market as markets look for direction this first trading day in September. Live from Studio 2 at Bloomberg headquarters in New York, I'm Bonnie Quinn.
And from Washington, I'm Kaylee Lyons. We are kicking you off to the closing bell here in the U.S., closing the session today, but of course, Bonnie, starting the month of September, coming off the worst month for the S&P 500 since February, even though August only brought a 1.8% loss, and not a lot of gain to start, even though we did have what was earlier being described as a Goldilocks jobs report this morning. The S&P 500 essentially unchanged at the 45.11 level. And we've seen, of course, a whipsawing in yields today. The 10-year yield right now up about 7 basis points at 4.17. The 2-year essentially unchanged at 4.88. And interesting to pay attention to what's going on in commodities as well. Oil north of $85 on WTI, the highest we have seen going back to November of last year, up by about 2.3% on the day.
Well, and you mentioned it, but here's some of the reason why. Solid hiring continuing in the United States, Kaylee. 187,000 jobs created last month. Hundreds of thousands more people, though, started looking for jobs. Underemployment ticked up and wage gains cooled. It all could amount to what could be a welcome picture, though, for the Federal Reserve, looking to hold steady on rates this month and then keep options open, wide open even, for Q4. Yields whipsawing today, plunging after the labour data and then reversing all of those declines and then some, as traders delved deeper into the NFP report and saw strength as well in the ISM manufacturing data, particularly in employment and prices paid. We'll get thoughts from the former New York Fed President Bill Dudley and also the director of the Cornell School of Labor. Chip stocks as well going their separate ways today as the AI narrative carries into September thanks to Dell's results. Intel, the Philly Stocks Index leader, Broadcom, the laggard. And it's not just chip stocks today. Stocks dependent on the affluent in general, from Lululemon to Toll Brothers, well, they're gaining in stark contrast to the low price point retailers, for example. And Kaylee, you reminded me that it was actually a full day of trading for the bond market today in advance of the Labor Day holiday. Typically it closes at 2 p.m., but I imagine it was very welcome for bond traders out there.
Yeah, there was a lot of data that those traders needed to digest, Bonnie, and initially it looked like it was a bid into the bond market off the back of payrolls. We saw the 2-year yield, of course, that Fed-sensitive part of the yield curve, drop to the lows of a session as low as 4.75 after the jobs report. Then after the ISM figures you were just mentioning, Bonnie, we saw them go as high as 4.89. Right now we're at 4.86. But remember, this time last week we were at 5.07, so we are still down about 20 basis points over the course of the week as this market reprices really what the Federal Reserve is likely to do as it reaches or gets near the end of its hiking cycle. And on that note, Bonnie, in light of all of the different data we have seen today, if you look at the pricing for what the Fed is likely to do this month, in the month of September, there is virtually no chance at all this market sees of a 25 basis point hike. Right now, those odds are down at around 6%.
Well, Kelly, for more market analysis now, we're joined by Nicole Webb, Senior Vice President and Financial Advisor for Wealth Enhancement Group. Nicole, thanks for joining. It's the first day of September and we've had this raft of economic data. What are we supposed to think going into the rest of the month?
You know, our story going into the end of the year, we've actually changed our tune a little bit over the last 2 months. It really feels to us that there is such a massive growth story to really offset the unknown weakness of the consumer in 2024. And I think that's where this narrative is, this ping pong match. And some of the charts you just showed on the 2-year, just intraday today, play into that, where we look at the jobs market, we think one thing, but then you go into the ISM August report and you actually see quoted in their inventories are just too low. And so have we bottomed out in manufacturing? Are we reaccelerating in some of these pockets? And then the spend forward that we anticipate in the AI frenzy across all areas of business at the enterprise level, you know, again, just reaccelerates that growth story. And so for us, we kind of expect more positive months ahead.
Well, you've said something that's a tiny bit concerning. You said that spend forward. Is that what's happening, Nicole? Are companies spending forward in anticipation that perhaps rates are going to stay higher for longer? And does that hurt future quarters?
Our bet is on an increase in productivity. So we saw a massive spend forward in the onset of COVID. That has implications on the backside that we're just starting to see. And so then when we think about the next leg of this, the spend into AI applications, again, we're still, this summer we were at near all-time lows from a productivity metric standpoint. And so forward looking, we do think that that's where a lot of this acceleration and growth will come from in light of not having as many available workers in certain industries and areas that we're accustomed to seeing.
Okay, so as we talk about where that productivity is going to come from, thinking about AI and technology, of course, it was tech that was the big contributor to the rally we had seen basically up until more recent history, Nicole. Do you think that comes back? Can tech continue to provide leadership in this market?
We actually do think tech will continue to provide leadership in this market through the end of the year. It's like the freight train that is just going to keep going into the end of the year. And that wasn't necessarily our consensus or our bet even 2 months ago. We started to look at the duration pressures around the technology trade, this fundamental belief that the hedge funds just certainly had to pull off some of those gains, lock them in short duration assets, and kind of sit tight through the end of the year. But instead, what we're seeing is NVIDIA is going to sell every chip that it can make. And when we look at Alphabet as another entity, it is the largest media company out there, and we're seeing an acceleration again in digital ad spend. So for all of these reasons, there's just this tailwind behind technology. And there's other sectors too that we think will follow suit. There is the 493 other companies, and we do see some of that broadening starting to happen.
On the subject of broadening, one sector that has largely sat things out is the banks. Even as the story theoretically improved from a fundamental standpoint, the concerns around deposits and the aftermath of bank failures we had seen this year, you haven't really seen the banks able to catch up, to recover from that. Do you think that changes in the near term?
I do. I think that as we move further and further away from this consensus of the recession narrative, when we think about the consumer, it just plays strongly into that's likely a pocket to pick up potential in the coming months. I mean, you look at the JP Morgans of the world, and they're trading at 9 times versus these technology companies, and at the same time offering a 2.6% dividend, which 18 months ago we would have thought was fantastic. And so as we return to normalized expectations in the future, these names are really strong and a little bit unjustly punished for a multitude of reasons.
Are we going to see a bifurcation, Nicole, between sort of the lower price point type stocks and the stocks for consumers that are more affluent, that are more able to afford to spend?
Yes. I mean, we continue to have this conversation around, at a broad level, we talk about the consumer holding in there. But in the day-to-day conversations we have with people, you can't escape the story around how expensive everything is right now. And so, it's not even necessarily high income earners. There's really this concentration of wealth in the baby boomer population. You see that read through in the labor reports. You see that the 55 plus is just not coming back to work. They're a huge portion of that second home purchasing, of kind of this pickup and spend, and they're cash buyers. And quite frankly, higher for longer is good for them because they tend to have a bit of a tilt towards conservative investments. And so they're just not being slowed down, and we're going to continue to see that play through into the names and their performance.
All right, Nicole, thank you so much for your time today. That is Nicole Webb of Wealth Enhancement Group. Coming up, we'll speak with former New York Fed President Bill Dudley about today's U.S. jobs report. Plus
Tesla's $41,000 discount. We'll discuss the revamped Model 3 sedan and the car maker's push to boost sales.
And Steve Ratner, Willett Advisors Chairman and CEO. His thoughts on the United Auto Workers strike. All of that and much, much more coming up. This is Bloomberg.
can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you'd want to see in a strong economy.
That was Acting Labour Secretary Julie Su speaking with Bloomberg earlier. Hiring picked up more than expected in August while wage growth slowed. Joining us now for more on the jobs data is former New York Fed President and Bloomberg Economics Senior Advisor, also Bloomberg Opinion columnist, Bill Dudley. Bill, thank you so much for joining. How confusing is this report for the FOMC? Is there anything in here that will move the needle on rates or even the SEP?
I think generally they're going to be take reassurance from this report because it does show a slowing in the rate of payrolls when you add in the revisions to the previous 2 months. Also, the size of the workforce has expanded, and that's the reason why the unemployment rate moved up to 3.8%. So more labor supply, slowing payroll growth. And the wage trend in this recent month was also quite subdued at 0.2% for average hourly earnings. So, you know, on balance, they're going to be thinking that this is consistent with the soft landing that they're shooting for. And as a consequence, the markets today basically said they're not going to raise rates in September, almost certainly. And they said in November, the chances of the Fed hiking rates is probably only 1 in 3 at this point. So the markets, I think, interpreted the report correctly. The problem is that the economy still has quite a bit of forward momentum. One aspect of the report that was on the stronger side is the total increase in hours worked, which is up 0.4%. And if you look at GDP growth in the third quarter, it looks like it's going to be quite sturdy. The Atlanta Fed GDP Now estimate after this report is 5.6% growth for the third quarter. Now, I don't think growth will be that strong, but it certainly is telling you that the economy really hasn't slowed down to any appreciable degree yet. And so there's probably still more work for the Fed to do. Now, I think the Fed's going to do that work mostly by keeping rates higher for longer, emphasizing the longer side rather than the higher side. But it'll be interesting to see what they do in the summary of economic projections, in a couple weeks, because they last time they said 2 rate hikes, they did one of them. This time, are they going to show one last rate hike, or are they going to say that we're more confident about a soft landing, and so we don't have to do any more? So I think the next meeting is going to be pretty interesting, not in terms of what they do. They're not going to do anything in terms of rates, but in terms of what they show about what they think they're going to have to do going forward.
If the data continued to come in the way they did this week, and I'm talking not just all of the jobs data, but also the inflation data today, and also the ISM manufacturing, quite frankly, is that an economy that would even need another rate hike?
Well, I think it depends on your view of 2 things. Number one, how tight is monetary policy right now? And 2, what are the long and variable lags of monetary policy? Is there still more restraint to be felt from the monetary policy tightening that's already been put in place? I think most FOMC participants view monetary policy as already tight, and that there's still some force of that monetary policy tightening to still be felt on the economy. And so I think I think the case for pausing is increasing. Whether it's enough to carry the day, I mean, it's going to depend on the data between now and the November FOMC meeting.
I'd like to return to your point about higher for longer and this idea of a soft landing, Bill. Theoretically, if the landing is soft, if we still are seeing resilience in the labor market and the economy, people are still spending, there is still plenty of demand, doesn't that mean the Fed would be more likely to hike as its next move, even if we do have a long pause for a long period of time? Why in that scenario would they need to start cutting anytime soon?
Well, I think the notion of a soft landing is that we get inflation all the way back to 2% without the talk about soft landing. I don't think they're talking about just continued economic growth. That continued economic growth is just the hard landing deferred. When people are talking about a soft landing, they're basically saying the Fed can pull this off without generating a significant rise in the unemployment rate and without generating a mild recession. And the fact is, the only way that they've been able to pull that off historically is if the unemployment rate doesn't really rise much. Every time the unemployment rate has risen by more than 0.5% since World War II, 12 out of 12 times, we've always had a recession when that's happened. So to believe in a soft landing, you have to believe that the Fed can sort of stabilize the unemployment rate around here, and that's good enough to get inflation all the way back down to 2%. That's what they're hoping for. But that's not what they're actually showing in their own projections. In their own projections, they have the unemployment rate going up to 4.5%.
So what about the belief in the 2% target, Bill? Do you think that is achievable this cycle in this post-COVID world? I know Chairman Powell at Jackson Hole said it is and will remain the target, but really?
Well, obviously, it's going to be harder to do the last mile than the first few miles because a lot of the downward pressure on inflation has been just unwinding the transitory pressures upward on inflation that we saw in goods prices during the pandemic. And as demand has now shifted from goods to services, goods prices are coming down, and that's pulling down inflation. Now we're left with sort of the tough part, right? The part that's really driven by the tightness of the labor market and the fact that wage gains are not consistent with 2% inflation. I think the Fed's view is twofold. Number one, we're going to stay the course. So they are committed to getting inflation all the way back down to 2%. And 2, it's going to take a while. If you look at the summary of economic projections from June, they didn't see inflation getting back to 2% until 2025.
Bill, is the bond market in any way confused? We've had quite a round trip over the last few sessions from 510 to 474 today it was at one point.
Yeah, I was a little confused by the bond market myself today. I mean, I thought that the bond market would look at this report as sort of benign and, would be reassuring in terms of that the Fed was not going to tighten much further. But I guess the bond market basically took it more as, gee, I guess the Fed's going to not be able to cut very soon, anytime soon, because the economy still has quite a bit of forward momentum. If we keep the federal funds rate at 5.5% for a while, that's going to weigh on a bond market that's trading, 10-year Treasury note yields are trading, more like 4.20 or so. So you can sort of imagine that if people extend their horizon of how long rates have to stay high, that will definitely weigh on the bond market over time.
Yep, 10's at 4.17 and the 2-year yield at 4.86 as we speak. Thank you so much for joining us, Bill Dudley, former New York Fed president and, of course, Bloomberg opinion columnist. Now, coming up, we're going to turn to a corporate story. Tesla's latest discounts will qualify one of its models for federal subsidies. We'll have more details on the company's pricing strategy next. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Tesla has now dropped the starting price of its signature Model X SUV by $41,000 this year. And that makes the car eligible for the federal tax credits revamped by the Inflation Reduction Act. Bloomberg's David Welch joins from our Detroit bureau to explain. So just enough to have them qualify. Will this boost demand massively, David?
Yeah, look, it should give it a real shot in the arm because not only they're obviously dropping the base price quite a bit, and it has been for all their models a lot over the past year, but then you get another $7,500 for that same customer, and you add that in, and they've actually dropped the price by almost $50,000, including the federal tax cuts. This year, that's a huge discount, even for vehicles that we're selling for, with the right battery and the right equipment, $110,000. So yeah, that could absolutely get them a lot of demand, and they kind of have to because the Model S and the Model X, they're two bigger, more expensive models. They haven't had a refresh, really ever, stylistically. So people have been looking at that same design for a while. And that also, that kind of mid to large sedan, mid to large crossover SUV segment, that's where all the competition's coming in from the Germans, from Ford, from General Motors, and Hyundai, Kia also have vehicles that are kind of, in that configuration, in that market segment. Mm-hmm. So more competition, some federal spiffs involved, and, they're pricing it about right at the moment.
Well, David, what Tesla enjoys that not all of its competition does is much healthier, wider profit margins. How much further realistically could they go on bringing pricing down and still be able to retain that?
Well, they've given up a lot of that, right? I mean, they always had this goal of being at 20% gross margins, and they slipped under that in recent quarters, and they seem pretty okay with it. So I think they're willing to give a little more, but at some point it has to stop because one of the reasons Tesla has such a high valuation is because of these profits and because they can grow so much. They can get the growth by dropping prices, but they give away the margins. They start to look like any other car company, and I think that could weigh on the shares if they keep doing this. And we don't really see an end in sight because they do keep trimming here and there.
And for all of those, any other car companies, what do these price cuts mean for competitors? I feel like every time we get one of these headlines that the price of a Tesla has gone down, we raise the price wars question. Do we actually get to that point?
In a way we have, because you are seeing, for example, Ford, they lowered the price of their Mustang Mach-E EV, and they said it was directly because Tesla was dropping prices for competing models. And that whole, you take the Model Y and the Model X, these are crossover SUVs, kind of. I mean, they're not quite SUV looking in the way they're styled, but they have that kind of room inside in terms of cargo and passenger space. Competes directly with most of the models that are out there. So that does put pressure on everybody else when the market leaders doing this. It's just basic economics, but also, Tesla is still the EV brand, despite the fact that new players are coming in. So it will. There are some other areas like pickup trucks that may not, electric pickup trucks may not quite feel that pressure because there aren't as many competitors out in those segments. But, the whole of the EV market right now is sort of like the vehicles Tesla is selling. Cadillac's Lyriq is kind of a similar configuration to that. They haven't dropped prices yet because they don't have any inventory, but over time they may be pressured to as as well as they get production ramped up. And you may see that you haven't seen the Koreans really drop prices yet, but you've seen their sales actually soften up a bit with the models that would compete there. So, we went from a monopoly to an oligopoly, and pretty soon we'll have full competition in those markets, and pricing will soften up.
A brief comment on what it's doing with its cars in China as well, David. It's giving them further distance, really, without having to recharge.
That's right. So the new vehicle's not really a radical stylistic change, but Tesla's all about technology. So longer range on the battery, a big touch screen in the rear seat. Styling may be a little more sleek, but still kind of looks like, pretty much the same vehicle. But it's all about the battery and technology with Tesla, and that's what they're going to be pushing. And they did raise prices on that vehicle, so they're hoping that the longer battery range is going to command that sticker.
All right, David, thank you so much. Well, right now, investors are reacting by sending the stock lower by 6%. That's David Welsh. Thank you in Detroit. More next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
This is Bloomberg Markets, the close. Let's get a cross-asset check as we head towards the close of commodities markets. Well, we've seen a nice rally for oil, staying above $85 a barrel now as those OPEC cuts kick in, 85.58 today. And that, of course, gave a big boost to many of the oil companies, Valero, Marathon, Freeport-McMoRan, and so on. Look at that, natural gas futures. They've had quite the ride over the last number of days. Well, the Baker Hughes rig count just came out, down 1. They had been down 10 the previous week, so it could be that those rigs are bottoming out finally, and that we shall see impacts of that, and also, of course, the potential for strikes in Australia play out in the natural gas market over the course of September. And copper as well, perhaps on the data out of China, up about 0.9% on that 3-month rolling contract right there. Very much worth keeping an eye on Dr. Copper. Kaylee.
Absolutely. When we think about the Chinese data and also all of the steps that China is taking to stimulate its economy and try to support its currency. For more on this, Tom Orlik, Bloomberg Economics chief economist, is joining us now. Tom, it seems like every single day this week it has been something new, whether it's the FX reserve ratio or cutting mortgage rates, trying to shore up the stock market by taking action on IPOs and the like. Does all of it add up to enough? And I wonder if that is what is reflected in commodities markets as you see oil at its highest since November of last year, and iron ore as well at the highest since April.
So let's be clear, Kaylee. The situation facing China's economy remains pretty dire. They've still got a huge problem with the real estate sector, where there has been much too much building and much too much accumulation of debt. But against that pretty bleak backdrop, the week we've just been through was actually a pretty good week. We had some decent data. The PMI numbers provide the first early indicator of what's going on in the economy in August. They were pretty robust, suggesting manufacturing maybe is starting to bottom out. And as you mentioned, we've had this drip of stimulus measures. Now, on their own, these are all micro moves, encouraging the banks to cut mortgage rates, freeing up some dollar liquidity to give a boost to the yuan. But when you start adding them up, it's still not big bang stimulus, but it's starting to look a little bit more substantial. And I think that's what the markets are reacting to.
Well, Tom, to your point, it isn't a bazooka. And I just wonder if the reason why we aren't seeing a bazooka type move from China is because they are unable to do something like really just rescue the property sector, which, as you say, is quite troubled, or they're just unwilling.
So I think the challenge, Kaylee, is that in China right now, the stimulus solution would provide a short-term boost to growth, but at the expense of making the structural problems that they're facing that much more severe. And that's just not a path that Beijing wants to go down. They don't want to juice the property sector again, only to add to the problem of overcapacity, add to the problem of debt, and face a bigger day of reckoning sometime down the road. That's why you're seeing this kind of drip approach, right? 15 basis points of rate cuts by the PBOC, a move by the PBOC to encourage the banks to reduce mortgage rates, a move to reduce down payment requirements. What they're aiming at is a kind of just enough stimulus, right? Just enough to turn a collapse into a managed slowdown, but not too much so they reignite an unsustainable boom.
So, Tom, those numbers you were talking about, the Xinjiang PMIs, where did that come from? Because it seemed like China was in a pretty dire situation, and yes, we had small moves, mainly sort of on the monetary policy side. Did that really trickle down that quickly to the consumer, such that they were suddenly spending on services again and manufacturing was picking up?
So it's interesting, Vonnie. China's got two PMI indexes. You've got the official National Bureau of Statistics PMI. That's got a pretty big sample behind it. You've got a lot of companies feeding into that survey. Then you've got the Caixin PMI, which provides more perspective on small businesses and private firms and exporters and has a smaller sample. So we're kind of seeing the same story from both surveys. We're seeing a story in August about a Chinese economy which is still weak, but at least things have stopped getting worse. The Caixin PMI had that little pop in it, as you suggest. We're kind of fading the significance of that because it is a small survey and so a little bit more volatile.
And then, of course, there's the support for the yuan, Tom. How long can China keep this going? How long should it keep it going, given that it's a little bit artificial?
So it's interesting, Vonnie. In the past, if you saw yuan depreciation, it would really be a kind of panic signal on China. Think about 2015, 2016, where you saw the yuan dropping and people thought, goodness me, is this the kind of the balance of payments crisis for China arriving? But what's happened more recently is the PBOC has engineered some changes in the way they manage the exchange rate. And what that now means is that they can allow yuan depreciation at moments of weakness to provide a bit of a boost to growth, a bit of a boost to export competitiveness. What they don't want to see, though, is one-way bets and excess pessimism triggering a sudden collapse in the currency and massive capital outflows. So I think what we're going to see in the weeks and months ahead is continued yuan weakness. We're going to see the yuan continuing to trend down. The Fed has got high rates, the PBOC is cutting rates. That's a natural pressure for yuan depreciation. But the PBOC is still in the market, providing a little bit of a stronger guiding hand than normal to prevent yuan weakness sagging into yuan collapse.
All right, Tom Orlik, Bloomberg Economics chief economist. Always great to get your thoughts on the second largest economy in the world. Thank you very much. We appreciate it. Now, still ahead, this move will impact the WWE and the sport as a whole. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
City. From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside? Time Time now for our top calls. Let's look at some of the biggest movers on the back of analyst recommendations. First up, Dollar General hit with a wave of downgrades after it cut its profit forecast. But let's focus on one from Evercore ISI. The analyst saying that the discount retailer has become a show-me story and is warning investors to heed and have patience until traffic manages to stabilize. For that reason, the stock was downgraded to inline from outperform. And as you can see, shares are down another 6.3% today after getting whacked yesterday. Next, Papa John's. Wedbush raising the pizza chain to outperform from neutral. Price target also getting a boost to about $95, up from $80. Same-store sales growth in North America seems to be trending above consensus, and the firm expects Papa John's to deliver strong operating margins in the medium to long term. Shares of Papa John's up 1.7% on a day where, don't forget, indices are not doing all that much. And finally, World Wrestling Entertainment, WWE. Wolf Research reiterating its outperform rating on the shares after a Saudi Arabian wealth fund obtained minority stake in the Professional Fighters League, or the PFL. The analyst views the deal as a new negative for WWE's valuation. Shares of WWE, though, well, they're fighting back. They're up 6.3%. And those are some of today's top calls. Now, the analyst behind that particular call joins us, Peter Supino, senior analyst covering media, cable and telecom at Wolf Research. So it's a little bit of a battle here being set up, Peter. What makes you think that WWE will not just survive but thrive?
Well, thematically, we have been and remain excited about the idea that the best intellectual property on the planet, and especially live entertainment and especially professional sports, really represent a toll booth on global consumer discretionary spending, and that the explosion of digital media, the internet in particular, really is a leverage point that favors the owners of that IP. And so we're bullish on the whole asset class, and WWE in particular is a very differentiated asset, very profitable business that over time has steadily appreciated in value. We think the wind continues to be at their back.
Peter, I feel like when we hear about Saudi money in sports, at least my mind immediately goes to golf and what we saw go down with the PGA in LIV and how that was just like a battle royale until they surprised everyone by trying to come together. Would it be the same kind of competition where one is stealing talent from the other, for example, and it really is like that, or is this different?
This morning we wrote that the answer to that question is about the world that we are in versus the world we hypothetically could be in. The transaction that took place recently between the People's Investment Fund of Saudi Arabia and the PFL Wrestling League was a 20%, rather $100 million non-controlling equity stake. We think that bought the Saudis about 20% of the PFL. What that means is that the Saudis do not have control of strategy nor of budget at PFL. And a team of American entrepreneurs who created it in 2018 and who have raised money from some very credible, down the middle of the road institutions are making the budgetary decisions. And that doesn't sound to us like analogous to LIV Golf, where the Saudi government controlled the strategy and the capital allocation. Now, the world we could find ourselves in the future, if things go a certain way and a chain of events plays out poorly for WWE and UFC, is that the Saudis get control of more than 51% and treat this as an investment platform without much sensitivity for returns. And that's just not where we are.
Right. Explain how this all happened, because remember during COVID, didn't the Saudis provide a bubble for the mixed martial arts world, which teamed up with WWE, and Ari Emanuel had managed to sort of make the whole thing happen, and now suddenly the Saudis are not so involved? Just explain the backstory there, Peter.
Sure. The Saudis have spent about $6 billion on sports rights in the last several years. That's a third-party estimate on sports investments and sports rights. That includes LIV Golf. It includes their soccer team. It includes the soccer league that they've just created, and a number of other things. And one of those other things is that they have they're home to two major WWE events every year that produce about $100 million of revenue for WWE. UFC and Ari Emanuel have a different history with Saudi Arabia. The Saudi government was a large investor with Ari Emanuel. And after the Jamal Khashoggi events, tragedy, however you want to call it, Ari sent the equity capital back to Saudi Arabia and is not presently in business with them.
And finally, Peter, especially given we are on a big economic data day here in the U.S., we got the jobs report. Signs are still pointing to resilience in the economy. If things do start to turn, though, when we're thinking about the experience economy and people spending money on things like live entertainment, does that leave names like this vulnerable, or are they recession resistant?
We look at the services as a percentage of consumer spending and also live entertainment as a percentage of that statistic, and both of them are below their prior peak levels. And all that says is the demand in this space isn't overheated. Having said that, there is a discretionary component to this. And so if you are managing a portfolio and trying to reduce your exposure to consumer discretionary, then certainly you need to forecast this business with sensitivity to that. Having said that, WWE in particular tends to trade as a non-cyclical business in the public markets, because despite that there are gate revenues and concession revenues and advertising revenues, the bulk of the revenues are locked in. They're TV media rights distribution deals that are not cyclical at all.
It really is a phenomenal sport, and phenomenal to watch the lines building outside when there's an event happening all over the country as well in the United States. Peter, thank you so much. A fascinating read. Peter Supino over at Wolf Research, and he has a price target now of $137 on WW, which is a 41.9% upside from where we are right now, or from where his previous price target was. Coming up, we're going to be hearing from Steve Ratner, Willett Advisors Chairman and CEO, about his concerns on the looming UAW strike. This is Bloomberg.
Replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.